Morning.
Morning.
Thank you all for being here for this important meeting. The first item of business is the agenda. Do I have a motion to adopt the proposed agenda as presented?
So moved. Second.
Moved and seconded. All in favor say aye.
Aye.
Opposed say no. Okay, we've adopted the agenda. Next item is to consider the December minutes. Are there any comments or additions to the December minutes?
Yeah, well, I did have one question, and I meant to ask this earlier. On the first page, Roman numeral 3, last paragraph said the committee received a human resources update from Mr. Hancock. I was just wondering, should that be Hitchcock, or?
That was a Scrivener's error.
I didn't know if you gave an HR update.
No. Rebecca gave one from Human Resources and Compensation. Mine came from the Enterprise, just an audit enterprise.
Yeah, that would be from Rebecca. So we just need to
Wait,
change.
I'm sorry, where's that?
The committee received a human resources update from, that's me.
That's
Sorry,
you.
that's me. Yeah, that should be Hitchcock,
Yeah, sorry, we'll correct that.
right?
Okay, may I have a motion to approve the minutes?
Move to approve as amended.
Second.
All in favor of approving say aye.
Aye.
Opposed say no. Thank you. We've approved the minutes.
Sure. Thank you. Mr. Chairman, if I could, I'd like to introduce one of our reports are we've moved to the end of the agenda, but we do have a new staff member that I would like to introduce at the beginning of the meeting. Destiny Gillo.
Hi, everyone.
Hello.
Aye.
Destiny is a junior analyst with the South Carolina Investment Commission. She joined in January of 2020. She attended the Indiana University of Pennsylvania, where she graduated with a bachelor's degree in finance and accounting. She is added to our IUP concentration risk, right? And I think that's like,
We're up to 3 now.
that's like 7.5% of the staff, I think. Is from
We're overweight.
we're overweight IUP. So but we're within the ranges, so we're okay. It's not a compliance violation. While at IUP, Destiny was the chief investment officer of IUP's student managed investment portfolio. She's currently in the process of completing her CFA and enjoys spending time with family and friends outside of work. So welcome, Destiny. to the team.
Welcome.
Thank you very much. Thank you.
Welcome. Glad you're here.
Thank you.
The next item is the Makita's capital market expectations. Jeff, would you introduce this item and our consultants?
Absolutely, and I don't have a whole lot, so mercifully I'll be brief. You may recall last year's capital market assumptions benefited from what was a very challenging fourth quarter of 2018. So that elevated the 2019 capital market assumptions. 2019 was a phenomenal year for most markets. And while that's great for the assets of the trust, it creates an additional challenge on a go-forward basis because we have effectively pulled return forward. So this more or less, what Frank is about to walk us through, takes us back very close to where we were 2 years ago in terms of the forward return expectations. So Frank,
Now that you've taken both the first and last slide of my presentation.
I'll let you make what you can of this.
Thank you, Jeff. So every year, we and every other consulting firm update our capital markets assumptions. And the reason we do this, because we need these assumptions to do a number of different things, not the least of which is to give you an indication of what your long-term expected return is. We do this in January. We do it using December 31 data, so however the market did in December through all of 2019 and as of December 31. Driven by a lot of different factors, interest rates, credit spreads, equity market prices, et cetera. As the CIO indicated, in 2019, almost every risky asset did particularly well. And you can think of that in terms of that's great from a calendar year basis, but it also means you're in some ways borrowing return from the future, sort of bringing future return forward to 2019, which then lowers your forward-looking return. Similarly, yields declined for most bond asset classes, which also reduces the forward-looking return for those asset classes. The net result, and I'm going to walk you through most of this presentation, how we do our assumptions, but the net result for you is that your long-term expected return declined from roughly 8% to 7.4%, and that's over a 20-year horizon. So let me talk about what we do, and I'm going to skip this page because I already talked about it.
Just one question. When you talk about your long-term expectations, how long is that?
So 20 years. So we actually create 10-year and 20-year assumptions. You'll see as part of our process is we start by creating 10-year assumptions and then turn that into a 20-year assumption. Actually, the one thing I'll mention is the bottom bullet point of this particular slide. We use both quantitative and qualitative methodologies. That's a fancy way of saying it's art and science. We do a lot of modeling. We're very proud of what we do, but with the end of the day, we recognize we're not going to get this perfect, and we have to be somewhat humble about our predictions.
Frank, before we kind of get into that, the one thing that I was thinking about that kind of interests me about long-term capital market expectations, and we're thinking about 20 years into the future and how the 20 years changes from year to year. To some extent, I think we kind of arbitrarily cut off what's happened last year, right? To a certain, it impacts the forward-looking return, but that doesn't mean that the 20-year expected return last year wasn't in the ballpark. We've just, if you think about that as a discrete 20-year period, you've just used up some of that forward-looking return in that 20-year period.
Yeah, we were right. We were just right sooner than we thought we'd be.
Correct, right. It's a sequence of the sequence of returns happened in a way that you brought some of that return forward, but that doesn't mean that if we, from 2019 to 2039, if we looked over that period of time, that wouldn't have been your return expectations looking forward for that 20-year period wouldn't have been close to where they actually may end up, right? It's just but now we're just looking at another discrete 20-year period moving forward. But I think that there's a temptation for us to sometimes to divorce ourselves from the past and not take that into consideration when we're thinking about the impact of these, if that makes sense.
I have a little bit of question, right? Because obviously the math works that way very clearly with bonds, but it may or may not work that way with stocks, right? Because if earnings are up and values are up, your forward return is still.
Growth can bail you out.
Growth, you should have the same forward return, right? But if you have change in valuations, right, then you can arguably sort of trim things back, right? So I think it's important to note kind of what those components are. And then while we're talking on assumption, the other one I've noticed, y'all use basically a 15-year rolling for the correlation assumption.
Yes.
Right. And I guess my question on that gets a little bit, right, kind of taking the discrete 15-year period, right? We've gone from interest rates, well, now it's kind of rolled off, but early 2000 rates versus where we are today, right? Arguably, you won't have the same correlation because just like those forward returns affect your forward expectation, they should also impact your forward correlation assumptions, right? Because your starting rates are so much different.
Are you saying, so the journey from 7% to 1%?
Yeah.
Creates different correlation than the journey from 1 back to 7? Is that
it absolutely would, right?
Yeah.
And I also say over that time, right, you've had a material reconstruction of bond indices over the last 25 years, right? So you go back historically, bond indices were predominantly corporate credit, and so you'd expect corporate credit to be more correlated with equities because they're the same cash flow streams, right? Government cash flow streams aren't necessarily the same cash flow stream as equity, so you get a more, at times, inverse correlation, right, between, you know, because we cut taxes and stocks go up, right, because that helps corporate cash flow and hurt government cash flow, right? You raise taxes, government cash flows go up, and corporate cash flows go down, so you get an 08, right? So the thinking through why these correlations exist, I think, is just as important as just taking a historical rolling, you know, series into the data set, I guess, right? And so that's the part that we spend a lot of time on the return, because that affects all the planning and everything, but I think it doesn't get discussed enough, kind of what assumptions should we really be using there.
And you're spot on, Alan, and it's why when we sit down and walk you through asset allocation, we don't just walk you through mean variance optimization, we walk you through all the other risk tools we do.
Yeah.
So we don't just say, all right, here's what this portfolio would be from an MVO standpoint, here's what it does if we do a stress test if rates go up. Because guess what, the Barclays Ag, the duration is 6 years now. It was 5 years, you know, if we go back 10 years ago. You know, so that duration change has a meaningful impact on what that's going to be. A yield of, you know, 2% or 1% as opposed to 4 or 5%, that's going to have a different impact. So that's why we do all the other things, the stress test, the scenario analysis, to build that picture in. We know that correlations are not going to be perfect, and that's one of the humble things you have to think about when you're doing MVO. There are a lot of faults here. The first one is the fact that, the past isn't necessarily going to indicate the future. The second one is that particularly standard deviation and correlations are not stable. We really don't care what correlations are like when everything's going up. What we care about are what correlations are like when, you know, equity markets are going down. So we kind of bias our assumptions in that way. You know, the reason we actually use a 15-year correlation and standard deviation, looking back, is because we had been using 10-year, and then we started rolling off the GFC, which then gave us this 10 years of, you know, completely six vol, you know, in low correlations. Like, no, this is wrong. This does not really represent the risk that's inherent in capital markets. So we extended 15. You know, if we have 3 more calm years, and we'll extend it even further. And we're just trying to capture the best we can the dynamics of capital markets. But at the end of the day, I mean, and the other part of MVO is it assumes this sort of bell-shaped distribution of returns, where in reality you get these fat tail events that MVO is not great. Which again is why we do the stress test and the scenario analysis and all those other things.
And I think, you know, my point was more along the lines of, you know, if we're thinking about this as, you know, from an asset allocation standpoint, as long-term investors, right? And we do have periods where there was a meaningful impact to our forward-looking return expectations that we shouldn't, and it depresses those to an extent that may cause us some concern. As far as the impact of the plan goes, we can't lose sight of the fact that that happens because we got the benefit of a really good return year last year, right? Which over that period of time will work itself through So, you know, that's.
Maybe I'll even take it a step further. You know, we wouldn't say that you should make an asset allocation change just based on changes in our assumptions from year to year.
I've got a question, though. Just kind of put this in perspective, at least for me. Am I right, Mike, about that in the SIOP, we're going to explicitly or maybe implicitly adopt these assumptions?
I think that we do put the we'll put the assumptions from year to year. We put the assumptions in the SIOP as a reference, and we indicate that the certain scenario analysis that we do is based on those capital market assumptions and expectations. But that's why I think we also attempt to show that because of the impact of market volatility, you know, and that there's a dispersion of outcomes, right? That we shouldn't necessarily expect that this is going, that if the portfolio gives us, for instance, a 7.41% expected rate of return, there's going to be an impact of that 12.9% volatility. So I think we try to do both and capture what we think that the return expectations are moving forward, but show that there's a substantial variability of outcome depending upon what happens.
Okay, I guess my question is, there's no motion on our motion sheet coming out of this. So does this board need to adopt a set of capital market assumptions that then would be used? And that's why I said, my
Yeah,
guess is
no, I
we're
get it.
probably implicitly
Yeah.
at least doing that in the SIOP, but I just wanted to see if that was true.
I think that our function in that regard is our selection of the consultant. And in my mind, we are taking the consultant's point of view about expectations, one, because they're independent of us, and two, because they should be more expert than us on these matters. Of course, if neither of those is true, then that doesn't work. But, I believe that currently they are true, and that's sort of my thinking, that we don't ourselves pick the expectation.
Yeah,
Mr. Chairman, I think I would look at it slightly different. I don't believe that we adopt their assumptions as our assumptions. I think we receive their assumptions, and that helps us formulate the asset allocation. That's it. I think there's a nuance. I don't think, if we adopt it, I think it implies that we are shopping for assumptions. I don't think that that's the right way for us to approach it. I think we hire a consultant based on what we believe their skills and abilities to be, and this is one of them, and we receive their input. I don't know that I'm saying anything terribly different, but I think adopting it, thinking we need a motion to adopt, I think implies that we have something to contribute, and I think that may be the point that the chairman was making.
Right, but I think Bill's question is, right, the SIOP is the only, I assume it's still in the statute, I hadn't looked at all, it's been modified so much, but that is one of our few statutory things we have to do, right?
yeah,
That
yes.
is it.
So when it becomes part of that document, it does become ours, however it got there,
Yeah.
right? And so, the question is, okay, well, is that what we actually want in that document, right?
But I think that it demonstrates that there is a reliance there's a reliance by us on that information. To the extent that, just as there's there's reliance on how we process that information as well. I think it informs the decision-making. I just don't know if there's necessarily a requirement to formally adopt them as the kind of the beliefs of the commission. Because ultimately that, we're, the one thing that we can probably be pretty sure of is that they're, with all due respect, that's not gonna be the outcome, right? That is not
It's
gonna
not
be.
gonna be perfect.
That is not gonna be the exact outcome. So I think and that's why I think it's important for us to think about this more as it's information that then we attempt to utilize to help us make decisions. But we understand that there's a variance of outcomes. And it can impact the return expectations when combined with the volatility, provide a dispersion of potential outcomes for the plan, which I think we try to demonstrate in the SIOP. To the extent that I have somewhat of a concern about us formally adopting something that we know in essence it's data, it's just an assumption, but it's not, this is not necessarily the only view that we kind of take into consideration as well. We receive capital market expectations from a variety of sources. We most heavily rely on Makita's, but Makita also provides us with the Horizon data too, and we think of, which is the kind of the amalgamated capital market expectations from all the consultants, and we utilize, that information as somewhat of a sanity check too. So, I think when it comes to I think by putting it in the SIOP as a reference, it just shows that this is information that we're using to inform the fiduciary decisions that need to be made. But
Historically, its inclusion has indicated that these are the assumptions that the expected return, expected volatility are based on.
Right.
I mean, whether or not we choose to formally adopt it, that
we could, and because we explicitly say these are the assumptions that we're relying on to produce these results. But I don't know if there needs to be anything more formal than that. That's certainly up to the commission to determine.
certainly can.
Sure, yeah, I mean, it doesn't, I don't think it, for lack of a better way of describing it, I don't think it hurts anything, but I'm not sure that it necessarily helps or informs anything either, to the degree that we're explicitly saying this is just some information that we're relying on to produce
Reynolds
these
Williams
results.
Is now joining.
Frank, what's y'all's experience? Do you see boards adopting a set of capital market assumptions, or just using it as information from various sources?
Very rarely do we see a board formally adopting capital markets assumptions. When we do, it is always a board that has a large staff that likes to have their own input on those assumptions and maybe modify them from ours. And we've done that with a number of our clients. It's a small number, but we've done it with them.
Okay, thanks.
Hi, Reynolds, can you hear me?
loud and clear.
Good, thank you. Glad you're with us.
Well, I was planning to come up there, but I have a new medication and I took a quadruple overdose this morning, so he told me not to drive.
We'll make sure that's in the minutes.
I hope it makes you feel good.
So far, I'm able to manage the phone.
Makes the markets look better.
Okay, thank you. Frank, back to you then.
Thank you, Mr. Chairman. One thing I know, we've been doing this for at least the last 20 years.
I'm sorry,
Go ahead.
just kind of beat up, but this rate, I mean, just because the rate environment, and I know we were trying to simplify our busted out allocation, and so we, I was just kind of looking at the chart and kind of looking back in the SIOP. We had basically rolled in, it looks like, investment grade bonds, treasuries, tips, mixed credit, EM debt, and then we kind of left private credit out separate, right? Presumably because it's, less than investment grade, I guess, is why we kind of separated it.
And illiquid.
And illiquid, but I mean, you could buy 144A. I mean, I hate to say, just being in the business, you can buy 144A from a large company and it would be considered a private security, right? And that's how a lot of debt does trade, right? So, my concern is just rolling down that bond class, right? There's a lot of difference under the hood of that one, more so than in equities, right? Equities just being equities, but like your international bonds have that currency component, right? You have rates and you have credit. Like I don't know. I guess I kind of have mixed feelings because we've lumped a lot kind of in that category of just bonds, generically speaking. But I'm just kind of questioning whether that's if we want to go that far in our roll down, because that can affect this high level asset allocation. Back to what I was kind of talking about earlier, right? Because credit bonds are fundamentally more linked to equities than say government bonds would be, like your tips and things like that, whether we don't need to just create a credit bucket and then, for lack of a better term, a non-credit bucket.
Credit and rates.
Credit and rates, right? Or you can do just your investment grade and then cut out your high yield. I mean, there are different ways to think about it, but I'd be curious what some of y'all's other clients might do on that, right?
So it's a little separate from this, but I would say,
And I bring it up because, right, sovereign bonds, we're at 15 trillion negative right now. And if US goes negative, we're at 50 trillion. So, I mean, it's not a little question. There are no functioning government bond markets at that point, right? So it's not a hypothetical anymore, right?
the default that we model it internally is we separate rates and credit, and for us, credit is the below investment grade portion.
Below investment grade, right?
So high yields, bank loan, public and private credit. EM debt, we tend to put in there, even though it's kind of a pretty good mix of the two.
So Alan, to your point, what is modeled here is ag.
Yeah.
What is available is EM and non-investment grade credit.
Right.
As off benchmark. So,
Can you define for people like me, what ag consists
so,
of?
ag consists of
We're talking the
investment grade.
Bloomberg Barclays aggregate, right?
Yes, investment grade, fixed rate securities,
Okay.
domestic,
So,
US ag.
Corporate and government.
so treasury
government
bonds, Fannie
agency.
Mae, Freddie, mortgage-backed securities, and corporate bonds. Tiny bit of ABS too. That's about it.
Okay.
And then, the non-investment grade, flavors, and these are flavors that have been in our portfolio and as contemplated would be available, but would not, in the target have a weight. It includes, high yield, which is non-investment grade, bank loans, which are, think of that as, the best way to think about that is floating rate high yield, and emerging market debt, both issued in hard currency like dollars and local currency, home country. And the latter of those two would involve a lot of more currency risk as a component of that risk and return stream. So is that helpful?
Yes, thank you.
All right, so, one thing I'll note is this, sort of the evolution of our process. When I started doing this 20 years ago, we were modeling 16 asset classes. We're currently modeling 81. There really aren't 81 different asset classes. There probably weren't even 16. It's just all the sub-strategies, that our clients want to see modeled, we model. So we've built that out over time. So the way we start this, and again, I'll give you sort of our own history lesson. When I started doing it, we use what you would call a risk premia approach. So it's pretty naive and actually pretty straightforward. The idea is you start with something that's equivalent to a risk-free rate. So whether it's like 90-day T-bills or 10-year treasury, something that's equivalent to a low-risk, very low-risk asset. And then you say, all right, how much of a premium, how much more do you expect to get paid for investing in a particular risky asset class? So stocks. So historically, you might see, okay, stocks have gotten 4 to 6% more than treasuries. So you would expect to get, if treasuries are yielding 5%, you expect to get 4 to 6% more than that. So maybe you end up with a 10% expected return for stocks. That works out generally over the long term, except that really doesn't take into account current market pricing. And ironically, the time we started doing this was around 2000, the sort of peak of the dot-com bubble, which is when we kind of learned, oh, wow, yeah, pricing really does matter when you buy something. So over time, we started building in pricing into our model. So for any asset class, there's usually 2 to 3 components to it. There's sort of an income component, a growth component, and then a current valuation. And that part's kind of important to us because we tend to assume that over the next 10 years, there will be some kind of mean reversion in pricing. So if PE multiples for stocks are above their historical average, we assume they're going to revert to that average over the next 10 years. So that means returns are going to be lower than what they have been historically. And you kind of see that in most of the models, not just our own, but most of the other consultants have expectations for equity returns that are lower than their historical returns.
Frank, at the end of that 10-year period, are you assuming everything has normalized, including inflation and the rates environment?
Yes, we're assuming at the end of the 10 years, everything normalized, and then to get from years 10 to 20, we assume you kind of get that normalized relationship over that time frame. So this page I like because it talks about, in a way, how good and how efficient are some of these models. So I'll start with the chart on the top left here. What we're showing you here, the vertical axis, that y-axis, is the yield on bonds at the beginning of a period. And then that horizontal axis is what the return is over the subsequent 10 years. And what it's basically telling you is that your starting yield is a very, very good predictor of the return you're going to get over the next 10 years. And these are investment grade bonds, so there's not a lot of default. There's some reinvestment risk, but you can see, up and to the right, there's definitely a relationship there. It's actually pretty tight around that, sort of best fit line. And for the geeks among us here, that R squared, that statistical significance is pretty high. And that's really what you want when you're looking at, is this a good indicator of future returns? You go to the right, and here we've got cash. You can see, okay, there's definitely a relationship there, but it's not as strong. It's bounced around quite a bit. And just anecdotally, I'll tell you, when we've gone back and we've looked at our own track record of predicting returns, the asset class we've done the worst job at predicting, cash. We did not assume, zero interest rate policy 20 years ago. And we missed that completely. We must have, I think we assumed something like a 4% return, and not even close to that. Another example, core real estate in the bottom right. Cap rates are kind of like the equivalent of our earnings yield for real estate. And here you see there's some predictive nature there, but it's much more scattered. So it's telling you, okay, this is something that's somewhat indicative, but it's definitely not as strong, not as predictive as something like yield on bonds. The bottom right one is one that's, maybe the most controversial. A lot of people like to argue about, expectations for stocks. Here we're using the Shiller PE, which is known as the cyclically adjusted PE. What we're doing is we're taking price relative to the trailing 10-year earnings inflation, gesundheit, inflation adjusted. You really don't need the inflation adjustment over the last 20 years. You do need it when you're looking at periods like the 70s and early 80s. It does come into effect there. And what it shows you is that over a 10-year horizon, there is definitely a relationship there. The more you pay for stocks, the lower your return tends to be over the next 10 years. Interesting caveat here, if you try to do the same analysis looking at the forward 1-year return, it's noise. There's no relationship whatsoever. It's just over that long-term horizon, that 10-year horizon, that you see a relationship there. All right, so I kind of already talked about this. We go from 10 years to 20 years. And when I mentioned sort of the art and science part, so this has all been the models, the science part of it. We have an investment policy committee that is composed of really the most senior people at Makita. At the end of the day, checks our work and does a reality check. Does that make sense? Is this reasonable? We try to build all sorts of internal consistencies. So we're looking at, sort of like capital asset pricing models. Do we expect, you talked about normalization of inflation and interest rates and everything. Should you get a higher return for high yield bonds than investment grade bonds? Should you get a higher return for equities than high yield bonds? Yes, all that we expect to see over that second half of the time period. I don't know how much you want to get me into the weeds on any particular version. Dr. Wells smiling. So.
Okay, well, can we just kind of step through very quickly? And so dividend yield is lower than normal.
Yeah, so this is how we build it for equities. So you start with dividend yield, the income you get, and as Jeff said, it's lower than usual. Not really lower than the last 20 years. Expected earnings growth. And this is an interesting one because we base earnings growth, first thing we base it on is economic growth. And we're not economists, so what we use are the projections. The IMF publishes twice a year, they call it their World Economic Outlook, and it's economic predictions for the next 10 years for every country in the world. So we use that not just for US projections, but for every other region. And then we tie our earnings growth back to that, but even then there are several caveats. If you look at the S&P 500, 30% of the revenues are coming from outside the US. So we say, all right, well, let's tie that to economic growth outside the US and do the same thing when we're looking at like emerging markets and developed markets as well. We also look at the impact of buybacks, share buybacks, what impact that has on earnings per share, and also net issuance of shares, because that flows through as well. The third thing is the multiple effect, which is a fancy way of saying are stocks cheap or expensive compared to their history, and they're going to revert to the mean there. And the last thing is if you're dealing with non-US assets, any kind of currency effect. The currency effect may be the hardest thing to predict, so we actually cap that at an impact of 1%, just because we know that's really the hardest thing to predict.
Curious, today, sitting there looking at currency effect, are you expecting
We're expecting,
positive or negative?
so we're expecting a tailwind for U.S. investors. We expect the U.S. dollar to decline if you base it on, look to the economists in the room, purchasing power parity, interest rate parity, differences in current account deficits. Those are the three main things we look at. Those have some predictive nature over the long term, but in the short term, none.
Have you had that view for the last few years? We haven't seen it.
Yes, but it's kind of, come and gone a little bit, yeah. It hasn't always been at the cap, I would say.
Can I ask you a question about that? Why do y'all start with dividend yield versus earnings yield and then try to make adjustments for buybacks, right? Because those are really corporate decisions and they're inversely related, right? And the buyback decision, like dividend policy, to the extent that you pay out more, your retained earnings are less, so your growth rate naturally would be lower, right? If you don't pay out any, your growth rate would be higher. I'm just kind of curious why y'all start with the dividend yield versus the earnings yield, and then trying to make adjustments for buyback, because those are corporate policy decisions, so it seems I don't say unnecessary.
Yeah,
but-
in a way, you do get the earnings yield with a multiple
Yeah,
effect, but,
yeah.
the dividend yield you actually get in your pocket, right? You don't necessarily get the earnings yield.
Right, but
Your pocket.
so many companies don't even pay dividends, right? I mean, just take the top 10,
Yes.
5 of them don't pay anything.
Yeah, so we're not
Makes
even.
the math easier.
It would, but we're not looking at individual companies, we're looking at the total marketplace.
Right, but I mean, everyone goes to the same MBA classes, right? It becomes cultural after a point, right? I mean, at least historically, right? You see these cultural ebbs and
Well, yeah, I
flows
mean,
on things
buybacks are a
like
good
that.
example of that.
Right.
For most of market history, at least in the US market, we were net issuers of shares, so actually diluted you as shareholders.
Yeah.
For the last 20 years, that's been reversed. Maybe all those MBAs have decided it wasn't worth issuing shares, because I remember when I was in school, they kept hitting your head, most of these mergers have actually been dilutive to shareholders, and eventually that took hold and people stopped doing as many mergers.
Stock options.
Yeah, and that's there. I mean, if you really want to get into the weeds, a lot of the controversies that, all these buybacks are going, to finance, they're actually, a lot of those buybacks are going toward, paying off the stock options, the vested stock options of employees. So there is going to the employees of the firm, not necessarily to the shareholders. Yield to worst, we really talked about. If you do have something like high yield bonds that may default, we account for a default rate and how much, they might recover in, a bankruptcy process, for example. The other inputs, as Alan was pointing out earlier, standard deviations and correlations. As Alan noted, we look at as the baseline to trailing 15 years, but we also look for skewness. So skewness is the statistical term for sort of fat tail. So if something historically has a fat tail, we kind of penalize that asset class. In other words, we give it a higher assumption. So you can see the example here, we're using bank loans. Historically had about 6.5 standard deviation, but negative 2 and change skewness. So we sort of penalize it by inflating that. The other thing I want to note is that you have to be careful when looking at the observed returns for an asset class that is illiquid, so private equity, poster child here. Almost every private company, at least in the form of a private equity partnership, is at least as risky as a public company, and often more, because there's maybe an additional layer of leverage on there, or maybe these tend to be smaller companies, not always, but tend to be smaller, so less concentrated, more concentrated, so less diversified revenue streams. So if you looked at the observed standard deviation of private equity, it's much lower than public equity. The reality is these are at least as risky, so we give them a standard deviation that is at least as high as the public companies. And we have to do that with other asset classes such as private real estate, private infrastructure, et cetera. We also have to do the same thing when we're looking at correlations. Because if you look at that observed correlation, it looks different for private equity and everything else. Like, well, again, no, the reality is just because they're not market to market on a daily basis doesn't mean they aren't correlated with other risky assets. We know that they are, so we sort of artificially inflate our numbers to account for that. The next couple of pages are a summary. We don't put all of our assumptions in here, but the major ones, the ones that are in your portfolio. just to give you a sense of the changes from last year to this year. You know, you can kind of look at that third column of numbers, you can see across the board, you know, negative, 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 negative. It just, everything's lower because, you know, interest rates came down, prices went up. I mean, it was a good year for your investments. And this is fixed income, equities, real assets, and most alternatives. The only thing really that went up were our real estate and infrastructure assumptions, and that's because lower interest rates mean lower borrowing cost for those particular assets. Mr. Hitchcock alluded to this a few minutes ago. So one of the actuarial firms, Horizon Actuarial Services, every year does a survey of the major consulting firms. There are 34 respondents to it last year, in which they asked them, what are your capital markets assumptions? And then they publish this. Unfortunately, they don't publish it until August, so you're looking at last year's numbers here. But the reason we really like this, and I think the staff likes this, is it lets you know that, you know, we're not crazy. Or at least if we are crazy, we have company. Because it shows, you know, the 10-year average, the 20-year average, and then our 20-year assumptions. And we're higher, I mean, on some, and we're lower on others. We're not consistently higher, we're not consistently lower. I'm fine with being different than the average. The other thing I would point out to you, because I think this is an important thing, if you go down across the board, in almost every case, the 20-year number is higher than the 10-year number. So most of the major firms out there are saying, we think the next 10 years is gonna be tougher than, you know, the 10 years after that. And that's because of where interest rates are and where pricing is.
Is there a reason y'all are, look to be consistently above on equities, those first three lines?
So yes, I think I know the answer to that, but I'm not positive because I don't know how every other firm does it. I used to think that other firms are doing something similar to us, where they were taking sort of that building blocks approach, and then they would take some metric in terms of valuation and say, okay, stocks got more expensive, so that should lower expected returns. Then 2019 fourth quarter of 2018 happened. These 2019 numbers came out, and stocks got a lot cheaper in 2018. So by that metric alone, your stock returns should have gone higher if you're using any kind of valuation metric. Instead, we saw the average equity expectation came down, which led me to believe that most firms are not doing a valuation-based approach, that instead they might be doing something more akin to, you know, a risk premium approach, which is pretty naive. But even then, interest rates didn't really go down either. So I don't know what a lot of them are doing. I think they're, I think a lot of them are just kind of like responding to peer pressure. People saying, oh, you should push your rate down, your expectation down, you should push it down. I think that's what's happening in equities. So we shall, so I sort of know, but I don't.
Okay.
And even, I mean, looking at this, 8% return, stocks have historically produced a 10% return, so, you know, we're not, you know, I mean, we're more conservative than what we've seen historically. And our 10-year numbers are, just as, you know, the 10-year average is lower than the 20-year average, our 10-year number is lower than our 20-year number. This is again looking at your portfolio, you know, the five sort of asset class mix. What you see, as I mentioned at the very beginning, expected returns dropped from 8 to 7.4. Standard deviation really hasn't changed. The probability of hitting 7.25 comes down as that expectation comes down. You know, you're projecting, I believe the actuary is going to come in and tell you you're moving to 7% most likely in about a year and a half. So at 7%, you still have 55% chance of making that. Looking forward, and you know, if you even want to be very conservative, I mean, even a 5% return, you know, 8% chance of making that.
So the, those numbers, the return, standard deviation for that five asset class mix, that's based on the benchmarks, the new benchmarks that we're adopting for each of those asset classes. So like we talked about the bonds earlier, that's just investment grade.
Yeah. So you see, the next page, we broke it out consistent with the way it had been done. So you could see, doing it that same way, doing apples to apples comparison.
Well, that's one reason I asked the question, because we've got the exact same, two different asset allocations, but we got the exact same expected return and standard deviation. Is that just,
So-
coincidence?
Well, I wouldn't say they're different asset allocations, I'd say they're sort of bucketed different ways.
Well, we don't have EM debt in this, bonds category, but, well, we've got it on the current portfolio. So there are differences. There's no question there's differences.
Yes.
Yeah, and part of the point Bill's making, I think, is that the vote we have as commissioners is on the broadly defined policy mix, not on the, what I would call more the implementation part of that picture.
Thank you, Mr. Chairman, because that's exactly the point of my question. If with those, since those numbers are the same, we're kind of using those numbers as significant information in our decisions, maybe not adopting them, but using them, they're the same. So I just want to make sure I know which portfolio they belong to. The current portfolio or the one we're expected to adopt later today.
Yeah, so they reflect wrong direction. They reflect the implementation benchmark, if you will. But I'll note that the net difference is going to be very minimal. So for example, if you include some of the credit portion of the rate sensitive, that would, lower your expected return here, but you're also likely, the CIOs indicated likely to move out of equity options into long-only equities, which have a higher expected return, which is going to offset that. So it's not going to be exactly 7.41, but it's going to be very close to 7.41.
Let me ask a question. You said it reflects the implementation benchmark, not the 5 asset class portfolio. But correct me if I'm wrong, but the implementation benchmark, we might have benchmarks, but whether we use them or you choose to deviate, the CIO chooses to deviate from the 5 asset class mix is a decision to be determined later. Over an implementation period. So I guess when you say implementation benchmark, I guess you're making certain assumptions that the CIO is going to deviate from the 5 asset class mix.
So we're using essentially the same implementation that we were using 12 months ago. Looking again at this 5 asset class, so the global equity here, pardon me, wouldn't include something like equity options, which has a lower expected return.
Can I challenge you on that? Why do you say it has a lower expected return, right? Because if you believe markets are efficient, then obviously the options markets are just a derivative of the underlying markets, so they should be just as efficient. Right?
Well, it's not futures. It's not S&P futures. It's put and call writing. Which the inherent idea is they're supposed to have equity-like characteristics, but not the same long-term return as equities. So it's kind of like I would, if I'm vastly oversimplifying, I would look at it as a lower beta version of equity.
Right, but essentially what you're trying to capture is some portion of the vol that's embedded, and vol historically has been 2x what the expected return is on equities. Right now, you're not going to capture 100% of that, but.
Yeah, because it's the sum of that minus negative months.
Right, correct.
Yeah. So
I don't want to get us off a sidetrack, but I just think, because I know y'all done some stuff with some options stuff. I know previously you hadn't liked it, right? But we were in a very vol suppressed world, and suddenly now we're not in a vol suppressed world, right? I mean, so the vol premium just went up by a factor of 4, right? And so I don't want us to allow central bank suppression of rates, of vol in a world where they could, versus now we may be in a world where they can't, right? To influence thinking on implementation. That would be my only comment. We don't need to take a lot of meeting time, but.
No, I hear you. Can I ask for a clarification on this page? Okay. Is this page, because I think the questions have confused me at this point. So on this page, the way that you model 2020, are you using, for bonds, are you using ag or are you using
We're using the same mix
the
that we're using
same
on this
mixes
page.
as found on the
Yeah.
left-hand side?
Yes.
Okay, got it. Thank you.
Wait, go back, please. I guess the point that sort of, the difference there, and it, I mean, it probably doesn't affect it from a modeling because the weights are so small. I just kind of point out versus what was in the SOIP document we received, right? It's squeezing down that emerging market piece, and my understanding is that high yield piece, which here under credit, are getting squeezed into that 20%.
Yeah, the bonds.
The bonds
Yeah.
on the prior page, right? So at a minimum, I would like that prior page to reflect this weighting, right? And have a credit component that we call 15 and lower the bonds, so at least there's more internal consistency between those two. Does that make sense? Right, so there we've got them squeezed into the 26, but go down a page, right? So there you've got the 7, but you just took out 8. Right, does that make sense? So on the prior page, you would be 18,
Yeah, and I think
not
you mentioned
15.
this at a
Yeah.
prior meeting, Alan, that you,
Yeah.
instead of bonds and private debt, you'd
Yeah.
rather see it as sort of like rate sensitive and credit.
Kind of like you have on the next page, right? Because that's effectively what you've got on the next page. So, I mean, to your point, you modeled it based on that next page, not really this page, which is why you've got the same stuff. But I think in our documents, we need to be just a little more reflective of that.
Okay.
But, and that's a good point. But as far as make sure I get the right term, the policy portfolio that the board adopts, the 5 asset class mix, even though if we did high yield bonds, and somebody correct me if I'm wrong, even if the CIO chose to invest in high yield bonds, that would be included in that first line bonds. But from a policy portfolio, there are no high yield bonds.
Correct.
Because the benchmark does not include them.
Yes. Correct.
So,
That would be an off
so
benchmark
they would be
decision.
aggregated into bonds if you use them, but to figure out what we, the board, are approving as a policy portfolio, we're not approving high yield bonds.
So, think of it
I
this way.
mean, they're available, but we're not approving that as our policy
What is
portfolio.
contemplated is a target portfolio that does not use high yield bonds.
Yes.
There is an allowance for the use of high yield bonds.
Yes.
And Alan, I want to make sure that I'm picking up where you are. When used, you want to see that broken out away from rates?
Yeah, I rather have kind of rates where we have bonds and where you have private debt, have credit, kind of more consistent with what we have on the next page. Right?
Yeah.
Because then you have a better sense of what tools are you using.
Yep.
Right? Are you using rates and duration, or are you using credit? Right? I mean, because we as a board, right, I mean, that's our big kind of lever to pull, right?
Yeah. So, and I want to make sure that we're speaking the same language
Yeah.
here. So, the target is a 0 allocation. When used, that creates a new line item where we're showing allocation and performance.
Right.
Right, okay.
And in this regard, there are a lot of things that we assume are constant that actually do change over time, but besides the real world. And one of them is that we have floating targets for some of these categories. And so I gather that the assumption we're making and the expectations is that the current targets are fixed and will continue over the 20-year period.
Yes.
Yeah, that's what's embedded in there.
Yeah.
Right. Yeah, the projections. And as you and I were communicating, the reality today, by virtue of various decisions we've made recently, is we are underweight private equity. So as a function of that underweight, we are overweight public equity because we're dialing into an overall target of equity. And would, regardless of whether they're fixed or floating, would choose to do that.
Of course, as an economist, I'm used to holding everything else constant. So I don't personally have a problem with it, but just thinking about all the things that do change over time, the picture gets pretty big.
So that's really it from our presentation, Mr. Chairman. You know, the last two bullets, what Mr. Berg started with, you know, the 2019 was a very strong year, which in a way sort of drew forward some of the future expected returns, and hence our expected returns for the portfolio are lower than when we sat here and presented this to you 12 months ago.
Okay, further questions about the expectations or comments?
Mr. Chairman, can I add something? I'd like to hear a little bit more from Frank, because last year, they shared a survey with us that talked about, you know, not constantly, you know, changing your approach, you know, year to year to year to year. How do you think, if at all, the decline in the expected return, you know, do you still believe that you kind of sit tight and you?
Yes, so holding all else equal, assuming, you know, the risk tolerance, for example, of the board of the commission has not changed, then yes, I mean, you are essentially back where you were 2 years ago. And I think you even said that, so. Yeah, the result of that survey, you may recall, was that best practice is to not make frequent annual changes. Anecdotally, we've seen with other clients, and I believe you also did an internal analysis of historical asset allocation changes that showed that frequent changes tend to be more detractive of returns. And so all the more reason that if it's consistent with your long-term goals, there's no reason to change it from year to year.
The spirit of that work was, correct me if I'm wrong, I don't want to put words in your mouth, as your forward returns are declining, you're doing something to try to risk up, or is it more generic than that?
It could be any number of things. It tends to be, what we've seen historically is some of the opposite, that after a decline, a board then decides, oh, that decline, like 2008, was outside our risk tolerance, so let us make a change now before the market rebounds and not ride it back up. That's the most damaging thing that you can probably do. In many cases, the best thing you can do, think about just the last month, during a period of volatility, is if you have a long-term plan, is to stick with it.
Thank you.
All right, then, thank you very much. The next item on the agenda is the presentation by our actuarial consultants. Mike, will you introduce them and this topic for us?
Yes, we're pleased to have with us today the representatives from GRS, and they are going to take us through, I believe, 2 presentations. One will be on the 2020 experience study, and also a presentation that will show us some outcomes from some different potential demographic changes and things like that to the plan. So look forward to hearing from them and learning more about the how we get to where we are. So, thank you.
Okay, great. Good morning. My name is Joe. This is Mark Danny over here. We work with PIVA, and we've met several of you before. This is the experience study that we're running through right now, presented yesterday to the PIVA board. And we'll kind of talk about what that is here at the front. We'll talk about the process, of why we're doing that and what that is supposed to do, and then give you some of the results. So in general, the entire evaluation process, the actuarial process, is based on a set of assumptions. It's not just investment returns, of course, how long people live, when do people retire, those kinds of things. And so every once in a while, you wanna make sure you're digging into that and make sure your set of assumptions are reasonable or best estimate of the future as you can, because it's important for decision making. And so the way this works, the PIPA board does approve ultimately those assumptions. You just had a whole discussion on what you're approving or not. In this case, clearly these assumptions are approved by the PIPA board for use in the valuation. However, I'm sure you're aware the investment return assumption itself, though, is actually prescribed in law and statute. So we'll talk about that process. It's always important to remember, though, that the assumptions are just assumptions, and over time, what actually happens is what's gonna drive the results. And so we can assume 7.25, but if we only get 6, then, that's where we're gonna trend. And we'll talk about payroll growth. If we're assuming 3, but we only get 2, that's what's gonna drive everything. The assumption just is good for decision making today, and help you to maybe anticipate some changes before you're actually there. So the process is, for a lot of the data-driven ones, is to compare what's actually happening to the assumption, and then decide if we think this is reflective of the future or not. Sometimes, patterns can emerge, but you can easily look and say, well, that was that one-time thing. That doesn't mean future trends should be different. And that's part of the process, is kind of trying to decide where that balance is. But we split this up. It's not just, well, we expected 100 people to terminate and we got 98. But we really break it down by age, service, categories, and try to look for trends and patterns throughout the entire time. So inside the valuation process, kind of the main assumptions that go into it. So you hire 1,000 people. What's the probability, how many of those thousands would be expected to actually make it to retirement and get a benefit? When will they retire? Okay, well, the benefits are based on salary, so what kind of salary increases should this individual have gotten over time? And then once you know what the benefit is, how long will you pay out that benefit with mortality? That's kind of the main assumptions that go in. And of course, what investment earnings are gonna be around to help pay those benefits is a significant assumption as well. Just for disclosure, there's a standard of practice that kind of guide us on what we should be thinking about, how we should be considering things, how we should be disclosing things. And this is just a list of the ones that come into play in this specific process. And just want to get into the definition of the word reasonable. So, if you look at, retirement patterns, for example, we can look at the data very specifically and see, look, for every 162-year-olds, 25 of them look like they're retiring every year. It's a very objective analysis. But you get into something like investment returns going forward, that's not quite as objective. I mean, there's a little more art to it, as was just discussed. And so the standard of practice says, well, you need a reasonable assumption. Well, reasonable is a hard word to define. It's like, well, it's not unreasonable is probably the best definition of reasonable you can come up with. So it says this is how we're going to define as an industry if something is reasonable or not. And so first, it needs to be appropriate for the purpose that you're actually doing this calculation for. And while that sounds self-evident, it's actually pretty important. This is an ongoing cash flow financing arrangement. We're trying to fund the plan. That's the purpose of the actual evaluation, is to make sure the contribution strategy is correct or appropriate. That's our purpose. Now, what's interesting here, though, we also have a different purpose, which is in the accounting books, to actually calculate a net pension liability that goes on the balance sheet of the employers. Those are actually two different purposes. Determining whether the funding is appropriate and determining what the net pension liability is two different purposes. You could come to the conclusion of having two different sets of assumptions for those two different purposes. For communications, we like to not. We would like to have one set of assumptions that we use for all purposes, and that way all the numbers are the same. But it could be two different purposes. It needs to be the actual professional judgment. So that's saying I have to own it. I can't just say, well, Makita says this, so that's what we're going to use. Well, Makita says that, and that's great, and they're an expert, and I can depend on that, but I also, at the end of the day, have to also opine on it myself. It needs to be based on current and historical data. Basically, that's what Makita just walked through. We also need to think about the future, if that future is going to be different in some way. And then this one here is maybe, a lot of times people say, well, you should use conservatism. You should be, the numbers you should give us should be higher than 50-50 probability. Well, the standard of practice, the goal is actually the best estimate. It's actually trying to be close to 50-50 and not having significant margin on either side for decision making. Now, you can then decide to add margin in, or you can decide, well, I would like to be at a 55 or 60% probability, or to fund a little bit more than this 50-50 number says. You can choose to do those things, but they kind of want you to start with the baseline of a 50-50 best estimate. And then the last piece, and y'all just walked through this with this other set of assumptions, you could take your individual asset classes and come up with reasonable expectations for each one of them, but then back up and look and say, well, wait a minute, those relationships don't make a lot of sense. And that's what this is saying, is that you look at each one of these assumptions individually, but then you need to back up and make sure that you have a collective set of assumptions that makes sense and tie together. Okay, so in this experience study, it's pretty quiet in general. The main change, we are recommending that the investment return assumption go from 7.25 to 7. That will be in 2021 because it's in statute and there's a process there. And we'll talk about in a minute. That was already part of when the 2017 funding reform was put in place. A lot of the scenarios we were basing on assumed we would go to 7% at that point in time. So you'll see the funding mechanism already has that built in, and a lot of the projections we've done historically already had that built in. And so we want to continue with that idea. The payroll growth assumption is how our revenue will grow over time to help pay for this unfunded liability. We're recommending lowering that from 3% to 2.7. Talk about why in a minute. Then you have these very, very minor changes here. Once you add them all up, you don't even move the funding period at all. So they're truly minor. And they're full report if you're interested. But
When you say increased probabilities of retirement, what does that mean in longer ways?
Well, so maybe we're assuming, the old assumption might have assumed for every 100 people that are age 60, we reach 20 of them choose to retire. The data is showing, well, maybe 23, 24, or 25 are actually retiring. So we bump up those probabilities to assume they retire a little earlier than the current assumption said. And a lot of this stems from the changes in Terry and return to work provisions. Back in 2012, we had a lot of data before 2012 about what those patterns were. And then when those changes were made in 2012 to reverse a lot of that, we had to try to estimate what we think the impact of taking the return to work provisions, changing your Terry, what that would do. And what's been a little surprising is actually it hasn't had quite as big of an impact as we thought it would. That people, I think, especially the ones that were close to that 28 year, 28 and out situation, kind of went ahead and retired even without the return to work provisions, which was interesting. I'm not sure that's going to be true down the road. Once somebody's 30 years away from that, they're not going to make that quite as. The one that was only 5 or 8 years away had already kind of decided, I'm getting to 28 and I'm retiring. I think they went ahead and did that. So that's what that means. It's just that compared to the assumption, we were getting a little bit more retirement than we were.
And has there been a general trend towards earlier retirement over the time period you look at?
No, if you look at the general trend, it's longer. If you look at the general trend, it's been waiting a little longer, waiting a little longer, waiting a little longer. It's just compared to what we had assumed based on the changes that were occurring, we're tightening that.
And what are some of the other key things in that payroll growth assumption?
I've got 2 slides on that specifically.
Okay.
We'll talk about that.
All right.
Okay, so best return assumption here, this is just kind of giving you the definitions, the anticipated returns of the plan's current and perhaps future assets. In the public sector, this is also used as the discount rate. If you're doing a private sector valuation or lots of other financial arrangements, you may not have investment return assumption be your discount rate. But in this case, we do try to tie those together. And this is set by statute, currently 7.25, and it expires in 2021. And so the process is going to be the PIVA board, if they choose to go with the recommendation of moving to 7, we'll write a letter recommending that to the General Assembly. This General Assembly next year's legislative session can choose to go with something different as long as it's reasonable. Or if they just let that recommendation go through, then it becomes a 7% for use in the 2021 evaluation. This is what's going across the country. This is the NASRA Fund Survey, which is the largest kind of 130, 140 pension funds in the country, and what investment return assumption they've used over time. So this is year here, 2001, 2002, 2003, and the bars represent the numbers that were in using that assumption at that point in time. So for example, in 2001, this white area was 8%. So you can see a vast majority of plans were using 8% at that time. And so you kind of go up and down, and you see how it's trended, especially the last decade, pretty fast trend up, which is actually down in the assumptions. The assumption's going down, the graph looks like it's going up. And the part really to look at is this section here, less than 7, so not, this is 7. These are the ones that starts with a 6 or something less than that. And you can see a pretty quick movement there, and that's the piece of this that I think is going to continue. It looks like there was a pause here when you look at just the median, but if you look in this section here, to me, it's just who actually looked at it. Because like in this case, people, we only look at it every 4 years. So there's a lot of people up here that haven't looked at it in 2 or 3 years, and that's why they're up there. So they're going to be looking at it this year or next year, and you're going to see that really begin to come down even more is my guess. But you can see kind of where everyone else is. So the 7.25 we're currently using right in the median, so definitely not an outlier to current data. What we like to do is basically kind of piggyback off Makita's work. This is your portfolio that we just talked about, kind of the summarized one. We did use the full breakout of all the individual subclasses. And what we look for, we like to use the investment consultant for that given fund. So in this case, we like to focus on Makita, but we're not just going to take theirs without verifying it. We also don't want to put them in a situation where they're having to shop their expectations for the investment return assumption. We want to make sure that that's all on the up and up. So what we did is we took their 2019 expectations, because we didn't have 2020 for a lot of the comparisons yet. And in the 2019 ones, it's very comparable. We also found they were a little higher, but maybe 30 basis points, 25 basis points higher than the whole portfolio. And while it could be because of the asset classes, a lot of times when we do this exercise, the investment consultant for that given fund will be a little higher than what we're doing in the survey, mostly due to mapping bias. Like they know way more about you, so they know exactly where all these different pieces should go and what's in that given subclass, versus we're just having to say, okay, well, that's just general equity from XYZ investment consultant. So there can be a little bit of difference. And so what typically happens is that the investment consultant themselves will be a little higher than what the average is. But what you see here, short-term 657, long-term 744. So this is consistent with what you just saw, the 741. But if you look at just the 10-year number, you're looking at quite a bit lower than the 7.25. And one thought process would say, well, this supports the 7.25, so let's stay at 7.25. And if this was if all we were concerned about was the return, then I think I could be sold on that. We have a cash flow model though. So every year we're paying out more in benefits than we're actually collecting. And so if you look at it more of like an internal rate of return model and you took those cash flows and then said, well, what's the return that you're having to take some of it out every time? Because there's a lot of money that we paid out over the next 10 years that won't be around to earn that next decade. And so in that case, we try to use something between these two numbers because we need to reflect this, because I think, it's not just Makita. You look at all the different sources, the probabilities that the next decade or lower is pretty consistent across the different sources that we look at. And so one exercise I kind of think about as well, if this was 744 and this was 744, and now I know this is 657, so shouldn't there be two different answers? Like shouldn't that, we should reflect that difference in some way. So we think the 7.25 is reasonable, but we think the 7 is a better choice for long-term decision making, and especially since it was already built into the Schedule B. You'll see that all the decision making in 2017.
Question. Since 7.25, Makita says we have a 51% probability on the asset allocation you use and they used. We have a 51% probability of achieving 7.25 over 20 years.
Right.
To me, that's borderline not so reasonable. 51% probability. So just wondered how you the certainty, the probability of these returns, you're using the correct numbers, but the certainty and the probability of those numbers, how does that factor into recommendations?
Well, it does, and that's another reason why I would rather take a step down here is to try to build up a little bit difference for the cash flow difference. So for example, we could take a return stream that gets us 7.4, and we could take those same returns and just put them in different orders, and run those scenarios with the same returns, just in different orders, and we get a wide distribution of outcomes. And so that's why we need to reflect this, that there is a probabilities, no certainties, that will be lower over the short term, in the number. But you're right, we're gonna be careful not to give too much precision to this whole process. What I find interesting with your comment, right, so you're saying that, let's say that was 48%. Like, would that be aligned to you, that would be say, well, that's unreasonable, the number needs to at least be 50%?
I think absolutely.
Okay, yeah, I'm not saying there's
I
not a
think
right answer.
absolutely.
Yeah, there's not a wrong answer, so,
Yeah.
I'm more in that camp, so, but I would say that there's plenty of professionals that aren't.
Yeah, I mean, I'm not, 51% doesn't make me comfortable,
Yeah.
but I've approved that in the past. Less than 50, yeah, I don't know that I would approve that.
Okay, yeah, that's fair, I tend to agree with that, like, I think we need to be able to support, and I would like to be 55 or 60, that's because how hard it is to come out, how hard it is to, if we do this for the next 10 years, it's gonna be hard, much harder to come out on the other end, because we've paid out so much cash that we don't have anymore.
Yeah, I mean, we're accepting the volatility in the asset allocations because we are struggling
Right.
to get that 7.25.
Yep.
Basically the same with 7, but yeah, so we're just having to accept that volatility, which I like, making an error on the low side. Yeah.
It's been a long time since I've taken my stats class, but it just hit me thinking of Bill's question, right? We're looking at a 20-year period, so I don't have 30 degrees of freedom, so I'm not actually at a large sample size,
No.
right,
Well,
in
there'll be one.
stats. Huh? Right.
We're gonna do this once.
Right, and so I'm just kind of curious how that degrees of freedom impacts that assumption. Are you actually at 50, given the degrees of freedom that you have on even a 20-year horizon?
Right, and I think that question
Yeah.
is is one of the reasons that you see this. Because, I will say back in here, a lot of the rule of thought was the arithmetic mean was reasonable because you're doing a present value calculation. But I think more and more, this idea that, wait a minute, this is so uncertain and that these probabilities, is 50-50 even right. And so, that's one of the reasons you see this shift is even moving to those questions. So anyway, so we do find the 7.25, like, it is reasonable, it does meet, just walk through the checklist, it is reasonable. And that's a good thing, because that means we can do the 2020 valuation at 7 and not have to qualify anything. But we do recommend 7 for 2021 and beyond, and kind of here's the rationales. And one of them that we haven't talked about is that this assumption, because it's in statute, it can only be brought up every 4 years. If we stay at 7.25 today, even though it's reasonable right now, that doesn't mean it, like, about 2 years from now, it may not be. And so, the way the statute works though, we can't open that door again until 2025. So, go ahead and get to 7 and give us a chance a really good chance that we'll be able to make it to 2025. Okay, so any more questions on investment return assumption? That's kind of the discussion there. The payroll growth, and this is used to project our revenue stream.
Sure.
Sorry, go ahead.
Just once, the thing that I think that, potentially to clarify is, the return assumption really, one of the things that the return assumption, it discounts the liabilities, but it drives the funding policies, right? So performance relative, like our investment performance relative to that will ultimately determine whether or not the contributions are sufficient to get us to where we need to be to fully fund it, right? But if our actual realized return over, let's say, the next 30 years falls below that return assumption, that doesn't mean that we won't, reach fully funding over a 30-year time horizon. It just may mean that contributions stay higher, right? So that there's higher for longer. So that I would say that the structure that we have in place now provides us with a much greater degree of security than it did previously.
Absolutely.
Because your funding policy is really, it's a much more conservative funding policy. With the pension reform bill, it was based on much more conservative assumptions. I think it was 4% a year until 2021 and 7% every year thereafter.
Right.
But I think, the one thing that I think is incumbent for all of us to keep in mind is all of these are just assumptions.
Right.
And the one thing that we can probably assume with certainty is we're not going to hit them over that period of time, but there are varying degrees of success, even if we fall short of the actual return being below the return assumption. The system is based in a way that it's going to force you to make progress towards your funding goals because of the way that the structure's put in place, right?
Correct.
Yeah.
And I've got a couple of projections in a minute, and I'll
Sure.
get into that exact point.
Yeah.
Because you're right, you're in a very good position as this group and the PIPA for this discussion because of your funding policy. For a lot of your peers, this is a much different discussion. Because changing this investment return assumption for a lot of your peers immediately changes the contributions.
Right.
In this case, they're not tied together.
Because ultimately, the practical effect of this will change if the return assumption changes. Because in essence, what we did in the pension reform bill to a certain extent was we kind of implicitly separated the discount rate for the liabilities and the funding policy rate, right? So ultimately what will happen as a result of this, if we go to 7, is that the unfunded liability will go up, but because of the conservative funding policy, you've already got that built into place. So you won't see an immediate reaction when it comes to additional contributions. Right. Whereas like a pension fund that didn't necessarily have that conservative funding policy in place, a move like this will most likely, because the funding policy and the discount rate are together, that would immediately trigger a contribution increase.
Correct.
Okay, right.
Okay, so payroll growth, this is projected, because our revenue stream at PIBA is based on percentage of pay. We get a percentage of pay as a contribution stream, and so that overall pay, how that grows into the future, is one of the main components of determining whether that contribution rate is enough. It's currently inflation of 2.25 plus 75 basis points is how we kind of building block to get to that. Nationally, it's been about 55 basis points over inflation. Of course, membership growth can be a part of this. In South Carolina as a state has grown about 1.2% a year last decade. SCRS has grown by about 35 basis points a year, so it's not quite growing as fast as the state population. And we want to be careful to build in membership growth because we're trying to pay a debt. And as soon as you start putting lots of good growth in there, it makes it real easy to pay that debt. So so the conservative position is actually to not give membership growth in. You can see the last 3 years, the last 5 years, the last 10 years, what's the overall annual rate of growth in payroll. In the last decade, 127, of course, while that's right out of the Great Recession. So we'll be careful not to overemphasize that. But you see the last 3 years, 262, compared to an actual inflation of 2. And in fact, if you take membership growth out, we're pretty much right at inflation the last 3 years. But really, if you were to only look at this data, the 3 still feels reasonable. The issue we're concerned about a little bit is as these contribution rates go higher, there's incentive for the employers to try to find ways to not include that payroll. You hire subcontractors and stuff, you do something a little bit different, and that we think that that's likely to impact us, and so we want to reflect a little discount for that fact.
Joe, what is the sensitivity of funded status or contribution rates and pick the unit of change in payroll growth? We went from 3 to 2. I mean, does that flow through in a material way?
This assumption on its own is only used in determining the funding period. Like we have, the unfunded liability is independent of this assumption. That goes into what individual salary increases look like. So your funded ratio, your unfunded liability don't change based on this parameter here. It's when we're asking the question, how long do we think it's going to be to pay off that unfunded liability, that this parameter comes comes into play. And this little change here, 3 to 2.7, I think it increased that funding period by about 0.7 years, so not even a full year, but a little bit more than half a year. And that's right now. Once the funding period's down to say 12, like the shorter that period gets, the less impactful this is because you don't have much time to grow, right? So, the closer we get, the less meaningful this will become. But I think right now, especially as this thing's ramping up, that's when you're gonna see employers trying to make those decisions. And so we'll go ahead and get a little bit of effect that. And we'll show that in a minute. All the projections, this is actually the biggest change because the 7 was already kind of built in. But this is the.
And Joe, when you talk about like really what it impacts is the funding period. Ultimately, what you need is, you need that payroll in order to, because we amortize at a level percent methodology. You need that growth in payroll so that the level percent of contributions on that aggregate grow sufficiently so that you're making, in essence, you're making both interest and principal payments on the unfunded liability, right? Yeah.
We got a couple of graphs just to kind of mortality, you can see we're right on, the dots are what the actual pattern's been. There's a little bit of adjustment. In this case, we actually build a mortality table right for the key data, just big enough data set. So anyway, so the impact, what we did is project forward to 2021, because that's really when the investment return assumption would actually change at that point in time. And so we go ahead and build in the next 2 contribution rate increases that are, so we know this final number here is based on the 1856, and that's the top. So it gets up to the top of the contribution rate schedule. So you've got current assumptions, what we project 2021 to be. If you do everything but the investment return assumption, you can see we get about a $100 million increase in the unfunded, but we actually get a decrease in the normal costs, and those two things a lot of times are just shifting chairs. They're just moving one to the other. And so if we only did those two, the funding period would be the same. And then when we change the payroll growth rate, it's about half a year of 0.6 years. So that's if we were to stay at 7.25, and you can see this is, we're well below 20 here. We're down 15, 16 funding period. Then if you do change the investment return assumption to 7 at that point in time, of course you're gonna get an increase in the unfunded. But we'll come back to that in a minute. And so you can see it does impact the funding period. And so what this is saying is, given the contribution policy and that it doesn't change, that it will take us 2 more years to pay off this unfunded if we're only earning 7 versus 7.25. That's what that's saying. Now, what actually happens is what's going to happen. So if we earn 7.25, if we actually do earn 7.25, we'll pay it off in 16 years. Like, it's this is all based on the assumptions coming true. And I would say like this unfunded going up, your real unfunded doesn't go up. Like there is some real unfunded liability, like there is some pattern that will go down. There is a real number. That number does not change based on any of this. We just have no idea. We have no way of knowing exactly what that is. So based on the current assumptions, it looks like on paper it goes up. But what actually happens is what's going to drive where we go. And this funding policy doesn't change. You can see here the contribution rates, and that's what Mike was just talking about. The rates are set in statute. They're not tied, and as long as certain minimums aren't hit, the rate doesn't change.
So that's saying under a current allocation, we're gonna be fully funded, at current assumptions, we'd be fully funded in 15.8 years?
Right.
I'm just, and you may not know the answer to this, but our SIOP, like early in page 7 or something, is that not predicting like 2042? Is there a difference between what our SIOP has and?
Well, think about there's a difference, what we're showing in the SIOP is the impact of volatility, right?
Okay.
So we are not, when we come up with that base case scenario, we're not assuming that we're going to get 7.25 or 7 every year, right?
Every single year.
So when you think about what are the.
Stochastic versus deterministic.
Sure, and that's just the difference in we're taking into consideration that dispersion of, probable dispersion of outcomes is vastly different than just a deterministic view. So that's what moves it. Like if we, there's an interesting chart that I can show you where we cut the volatility in half. Mm-hmm. And it has like if we could, if we were back where, interest rates were, at near their averages and the 10-year treasury was getting more like above 6 rather than 1, and you can structure a portfolio with half the volatility. It's amazing what it does to
Right.
those outcomes.
Okay,
Yeah,
so,
so it's
so
the,
this is sort of assuming the best case scenario where we get 7% every single year. We have 2.7% payroll growth every single year. We have all these things hit exact targets
correct, yes.
every single year consistently.
And the way that investment return flows through to the annual valuations is we use a 5-year smoothing for the investment losses, so you don't have that volatility in the amortization period on a yearly basis because we smooth the investment gains and losses in the actual annual valuation process.
Okay, well, we'll put some deterministic, just quick projections together, just to kind of give an idea of what's the actual impact. And as Mike said, the actual funding is not tied to the results. So this line up here, this is what the actual funding is expected to be. It's going up 1% a year until it gets to 1856 in 2023, and then it's expected to stay at that line. This is what we are determining the minimum, or kind of what our calculated contribution would be. And so as long as these lines are below that line, the funding policy will just stay on that line. If that makes sense. So as long as we're below the line, nothing changes. And so the red line here is what our projection is right now with the current 7.25% and the 3% payroll growth. And so if you go to all the other changes except investment return, you can see the payroll growth number pushes up, but effectively it's hardly any different. And then when you do go to the 7, you can see it does, but you still have a lot of gap. We still have quite a bit of room between that and what's actually scheduled. And back to the same point, if we actually earn 7 going forward, even these lines would be up there. Like, you know, it's gonna be what actually is happening, not what we're assuming is happening. So quite a bit of room there, between the rates.
What's the funding period there?
That's
On the lower lines? Is that still a 30-year funding period?
No, it's coming down. That's what this slide, so let me,
Okay.
using this slide here. So this is the maximum or minimum, it's maximum or minimum.
Maximum permitted.
Maximum permitted. Sometimes it's called minimum, but I don't think that's right. So it says 29, and it's coming down to 20. So it's the maximum that it can be is coming down until it gets to 20, and then it stops at 20 as the maximum. But the contributions are held up, so that's gonna continue to push you towards 100% funded. Okay, so it's gonna come down, and then it's gonna stay at 20. So this line, these lines are calculated based off that funding period at that point in time. And so it's saying, what's the funding period based on current contributions? And you can see it's coming down one of the year all the way through the process. So the red line is what the projection was before, the old assumptions, change the payroll growth rate, just barely different. And then if you change to 7, you can see we still come down kind of 1 a year as we go through this process. And we've got a pretty big gap out here between what we're actually putting in, what the minimum is that we need to put in.
So the part held constant is the actual contribution rate, the 1856. And so based on, as long as you keep contributing the 1856, this is the projected period to attain full
Right,
effect.
so the valuation this year, we'll be asking the question, if we continue to get 1856, how long will it take to pay off the unfunded? And it's saying it'll be 10. But the statute says it needs to be less than 20.
Right.
So that's your gap.
I'm sorry, on the previous page, is that saying we are never gonna hit the maximum employer contribution rate then?
Yeah, we are not expecting to hit the maximum.
There's
We're
a
not
chance.
expected to be required to increase it more than the 18.56. So the contribution rate will get to the 18.56, but we're not expected to, under any of those scenarios, reach a point that we have to increase contributions beyond the 18.56.
You could always create a scenario that would break it, but
That's
that's,
actually pretty hard. So that's what this is the same projected contribution rate, but this is the scenario 5B that was used in 2017 in the legislative process, and it includes a couple things. It includes going to 7% return assumption, so even the red line one does, because that's what was used. But it also assumes we earn 4% for the next 5 years. So we earn 4% for the next 5 years and then get 7 after that. So actual outcomes, and you can see we still don't get up to having to get more than 1856, even if we earn 4% for the next 5 years. And there's still a little bit of gap there. And so in this case, you can see the new assumptions, really the only difference is that payroll growth rate, 3 versus 2.7. same thing with the funding period. And so you can see that we still have 3 or 4 year gap there, even at the minimum spot, and then the cap starts to open up. Okay, any question on SCRS? After you have the results for board and things, but really it's the same story. They're a little bit better funded. And then, judges, same thing, contribution rates won't change, they're 22 years. Now, GARs and the National Guard are a little bit different, they are actually funded, actuarially funded, so they have a closed amortization period, the contributions are actually calculated to meet that amortization period, but the actual employer contribution goes up when this occurs. But I'm gonna argue the state can pay, $6 million, $100,000 more than this. So, anyway, that's the summary of the experience study. So that's return assumption, which was already kind of baked in, and then the payroll growth rate.
Questions and comments about the experience study with Joe? I suggest, sorry to hold you off, but I suggest that it's probably a good time to take a 5-minute break before the next presentation, probably because of my age.
I must be there with you.
So 5 minutes? It's now 11:05.
Hey, you call?
risks that kind of loom out there that are also not built, explicitly built in the evaluation, but I think they're important to note to inform this board. We just think of the volatility, and I wanna ignore the direction, the gains or losses, but pay attention to the magnitude of the gains and losses. You can see just inherently how much, on the investment side, the short-term risk, the annual risk, or from what the expectation is, how much different that is on demographic side. This is just saying demographic behavior at the employee level or a large group of employees is very predictable versus short-term investment returns. So again, membership behavior, which is the assumptions built in the actuarial valuation, largely predictable. But there's some other risks or things that could occur outside the assumption that we have to keep the eye on the ball. PB has to keep their eye on the ball. Some of these include legislative action or potential legislative action. We'll give a couple examples. Is there possible adverse or consequences of the increase in contribution rates? And then what happens, let's say the next economic downturn, budgets get constrained by employers. Think of the contribution rates, 2012, the employer rate was 10.6, 2023, it's gonna go to 18.56. Same thing with the member rate. To kind of give clarity on what this contribution rate comprises of, you think of the normal cost rate is about 10.5. The member pays 9%, are they paying that the value of the benefit being earned? And then the employer picks up the difference, which is about 10.5, or about 1.5% rather. And then the remaining amount, about 17% of the contribution the employer pays, actually goes to finance the unfunded liability. So the vast majority of what the employer pays is not for providing benefits, it's to finance the unfunded liability. Employers can see that this is a big cost. It's a material cost for an employer. What the risk is of increasing the rates from 10 to 18, it creates budget constraints. Maybe them hiring workforce or maintaining the workforce that they currently have. And as a result of that, they may look for ways to restructure the organization to be more efficient with our operating budget, which could include the use of outsourcing, contract workers, somewhere to get the same amount of work done and more productivity done with the same amount of budget, as their costs are increasing.
Dan, can I ask a question? Sorry,
Yes.
I don't mean to interrupt, but when we look at like this comparison between 2012 and the difference between the member and the employer and the amount that is going towards, the amount of the employer contribution that's going towards normal cost, and the amount that would be going towards, which is a very small amount going towards the normal cost of benefits now, right?
Mm-hmm.
Is that what would be the difference in the do you know what the difference in the breakdown and what back then would be?
Back then, let's say the normal cost was it was about 12.
Okay.
And, that would be your ballpark. So it was a little about 50-50.
Right.
A little, or close to that.
Right. And
back then, so to give you a little history about it, in 2012, when the enactment of the pension reform in 2012, when the member rate was gonna go up and the employer rate, it was the principle behind it, the theme behind it, was gonna be a shared responsibility. So whenever there was gonna be an increase in the contribution rate, the member would have to pay more and the employer would have to pay more by the same amount. The idea was it's shared, and that any contribution rate increases are not borne by the estate or not solely borne by the employer.
Right.
So that's kind of how things progressed from the 6.5 to the 9. Same thing with 6.5 to 9.75 for porters.
But just for purposes of, I think the one thing that I think, we recognizing that employer contribution rates have certainly gone higher, right? But there is a purpose behind that, because now, instead of, only having the requirement that we remain at a 30-year amortization schedule, we're actually required to move through that amortization schedule, at least until we get down to 20
Absolutely.
years. So that there's a benefit to the additional contribution.
Absolutely. This is the funding policy put in 2017, without a doubt in my mind, is a much stronger funding policy, and is a result in the system being more sustainable than the prior policy that was in effect. It was definitely an improvement. It's not to say what we're pointing out, there's possibly some side implications. Think of the risk due to possible legislation. And so these are employers seeking out to legislators. We have this idea, what do you think? And one that came out in the last legislative session, Senate Bill 258, this was gonna allow part-time school cafeteria workers to opt out of the system, opt out participating in SERS. So, small group, small pay, these are generally higher turnover. Our position on this was, this in itself is not material. However, we have concerns about it from a principle-based approach, because if you let this group out, or if you accept this and then, agree to them, what do you do for the next employer that comes, and the next one, and the next one? That's really the risk. And, so it's principle-based of, collectively, if you get more, then now you have something material. And then something in House Bill 4536, this was in the 2014 legislation. There was a question about employees participating in hospital employers, the ability to opt out of membership. Now, what I want to clarify was provide future employees who become employees of the hospital the ability to opt out. So if you're a current employee in the hospital, you are currently in SERS, you stay in SERS. This was on a prospective basis only. It turns out this was a bigger employer. We talked about this one for the cafeteria workers. Here we talk about the employers in the hospitals. Again, these are 2004. It's actually based on the 13 vows, so the numbers may have, if we looked at them today, may be different. I don't know what direction. The number of employees, you think of the demographics, the liability. This was in 2013 vow. So while there's only a few hospitals or a few employers involved, in particular, about 3 of them are fairly big size. So.
But both of those failed to be
They have
passed?
not yet passed. I will say they have not yet passed.
Yeah.
There's nothing to say that they may not be reintroduced in the future and something may happen again, but that's a great question. Thank you.
And there is a bill, in the Senate this year. It's just pulled out of subcommittee and is on the schedule for Senate Finance. That doesn't mean that they will necessarily take it up, but they would let hospital employees opt out of the system. We have provided them with some. We provided them with some financial analysis of what that impact would be. It kind of goes back to that whole.
Hello?
Please hold, call the answer.
All right, thank you.
But it goes back to Danny's earlier assumption change of the payroll growth. If employers start outsourcing their employees or letting large groups of employees opt out of the system, then that reduces the payroll. It doesn't necessarily change the liability because we're not counting on that liability from that individual, but it means we're not collecting the money to pay down the unfunded liability, so it changes that payroll growth assumption.
Does the bill discuss details regarding how the liability is calculated for the employers that want to opt out?
That's something that we have been in discussions with the General Assembly. Right now, there is no provision in statute for an employer to opt out of the plan. There is a bill that made it from the House to the Senate last year, and that's House Bill 3620. The bill was originally drafted to allow people who had been retired but out of service to the public for at least 12 months to return to work without an earnings limitation. But they would have already separated from service, and they couldn't have worked as a 1099 or contractor in any capacity for an employer, and they would be able to return to work without an earnings limitation. That was the primary basis of the bill. We asked them to add language to sort of contain that impetus that employers had to hire someone in a 1099 capacity versus as a W-2 employee, so that we wouldn't see the seepage of those contributions. That bill is still sitting in Senate Finance, and I'm not sure whether they will take that bill up yet or not this year, but we do have some financial analysis for them on that bill as well.
Danny, I have a question. Have y'all looked at another bill, Senate Bill 167? That's the South Carolina Shared Risk Defined Benefit Plan. It seems like that may even have a greater impact because that's going to close SCRS to new employees.
We have done some preliminary analysis on that, and
now we're gonna, you know, I'm not making a value judgment, but now the state's would have to fund two plans, which might take resources away from SCRS.
It does. In the shared risk, the concept is it goes back to in 2012 when the member and employer rate went up together. That was a shared cost type of approach. This and the shared risk is try to mitigate some of that risk or the cost. What I think that bill didn't explicitly address, and it's been a while since I looked at it, so don't take me out of context on, but it really focused on the new plan, but it didn't really have a lot to address the existing unfunded liability, which is our biggest concern.
Yes.
So that bill, just to clarify it, we did write a response to the author of that bill to let them know that the bill doesn't have enough components in it for the actuary to do a financial analysis, because there's statements in the bill that says employers will have to pay money to pay down the unfunded liability, but there's really no mechanism in the bill to actually make that come to fruition. So the bill isn't in a format right now that we could actually do a fiscal impact on it. But something that's similar to that is there's another proposal to close the DB plan, SCRS, and move all employees into our current optional retirement program, which is, a defined contribution 401A alternative. And that we have been able to do a fiscal impact, or the actuary's been able to do a fiscal impact on that. And what you really see is for every additional group of people you transfer to the DC plan, when Danny was talking about how much of the employer contribution goes to pay the unfunded liability, because the employer is only paying, less than 2% of normal cost. Well, when they go into the ORP, the employer has to put 5% of the contributions into that participant's account. So you automatically lose 3% of payroll for any shifting of the demographics for employees to go into ORP versus SCRS. So it does have a significant financial impact to the plan.
Yeah.
Well, and also if you're losing the benefit of the employees' contributions too, well, like for the ones that would opt in, then that causes a cash flow problem for us as well, right? Right, because
that's a cash flow problem, not a really liability problem.
It's a cash flow problem, not necessarily.
Down the road, it creates a material cash flow problem.
Right.
Absolutely.
Yeah.
So that's another cost.
Right. So if you think about that difference in where we were before pension reform with the net negative cash flows and where we may be, that gets us back there or probably worse at some point.
Eventually, it does get worse.
Yeah.
Absolutely. We looked at legislation in terms of employer behavior. If you look at it on the surface in terms of contributing membership, how it's changed over the years, active membership, SCRS, and FORS, covered payroll, on the surface, yes, things look good, but what's activity going on underneath? And this is something PIVA's been watching and monitoring for at least 3 years. And that is what's going on in headcount and payroll at the employer level. and they're trying to identify trends, and to see if there's what type of behavior is gonna go on at the employer level. There could be legitimate business reasons that maybe a head count's decreasing over time. A lot of cases, we're still seeing increases in head count, but it's something that, it's an activity performed by PIVA. That we have. What if you have these, we're talking hypotheticals, what ifs, nothing in specific, no employers are called out here. But what type of actions, if you have this type of behavior? Obviously, you have your legal action, possible legislative action, you get other groups involved, go to the courts, you have those obvious directions. What do you have in terms of, on the funding side, the actuarial side? One possibility that I know it has been used in a different system is essentially you take those employers, you isolate them out, we call it quarantine. Their liabilities, they're essentially funding their own liability, their own with an allocated assets on their own going forward. So the idea is when they cease participation or cut back on their participation, somebody else is financing their unfunded liability. So it's trying to quarantine them, trying not to have the other employers subsidize them. The other action, and this again would require legislative change and policy set by PIVA, but when you're currently an employer in SCRS, you're an employer for life. There is no opt-out, there is no voluntary cessation. So there are other systems such as California PERS, Kentucky retirement systems, New Hampshire retirement systems, for example. They all have provisions that allow certain employers to voluntarily opt out. When they do that, then you create, it's like a solvency liability. And the focus of the retirement system is to protect the remaining employers. It's not to give a break or to those who have to opt out, but it's really, you want to protect the remaining employers from the risk, as once they're out, the remaining employers are assuming all the risk and the responsibility of financing those benefits. So when you do that, you do it on a solvency type basis, that you take into account a risk premium when you determine those costs. So it's not a liability on an ongoing basis anymore, it's something very different. In the case of these other examples, they use an interest rate tied to treasuries. You think where treasuries are today. You compare that to the assumed rate of return, it's a very different number. Very expensive number. And then, of course, how they pay for that, how they finance is a finance decision. Other instances of opt-out, you may have, there could be business reasons they're out of business. And that becomes, the question there becomes, in terms of policy, and not just for PIVA, but maybe for the legislators, is what mechanisms are in place to protect the remaining employers, the remaining participating employers in the system in that instance? And do you treat them the same? Do you treat them different? And those are policy types decisions, and I'm sure that could go through a lengthy debate. The other method, and this one is being explored by another statewide retirement system currently in the legislation, and that is how are we collecting contributions from employers? And currently for SCRS and in the vast majority, almost all cost sharing systems, you collect contributions as a percentage of payroll. Well, and that's a very efficient manner, but sometimes you can have some breakdown as contribution rates increase. And we're talking contribution rates well into double digits, a multiple of what the 1856 is. And so there becomes significant increase incentive to reduce active head count. And so as that, there's a breakdown, it's almost like a death spiral. As the head counts go down, the covered payroll goes down, contribution rates to maintain the same dollars have to go up. And so we have a breakdown. And so how do you pull out of that? And so one alternative is you collect contributions, or at least the amortization cost, as you invoice each participating employer based on a funding policy. How do you allocate it? What method do you allocate, the required payment, amortization payment?
Are you turning it into fixed dollar?
It is a fixed dollar,
Okay.
yep. And what that does is you now have a fixed cost, and then your marginal cost becomes your employer normal cost. So even if an employer further reduces headcount, it's a fixed cost on the amortization, which is by far the largest component, and it does little with their operating budget. And then in the converse, if you have a growing entity, they're not penalized by increasing their employee headcount.
Yeah.
So the challenge is, there's really the most significant challenge is, what method do you allocate this amount? Do you continue on some payroll-based measure, which is representative of what they contributed in the past? Or maybe it's liability-based, to where it's representative of what's the liability attributable to their current and former employees. One of the hurdles, because this hasn't really been performed, one of the hurdles to be met, to be cognizant of, is there's some federal reimbursements that go on certain governmental positions. And according to the policies, you can recover an actuarial cost that's determined reasonable and appropriate allocation method. And what they deemed to be reasonable is an actuarial determined amount, and an appropriate allocation method being payroll, some payroll-based allocation. So if you deviate something from that, are you gonna continue to get federal reimbursement that you're asking for, or have you put that somehow in jeopardy?
Yeah, I like this idea, or what we're running into. I've got a client where the contribution rates are getting close to 30% of pay, and about 3% of that's normal cost, 27% of it is going towards the unfunded liability. And it's a cost sharing plan, and it's a teacher plan, so, you have a school district, and they've got 50 teachers, and they're like, man, we really need 3 more teachers, and that's gonna cost us, $80,000 each, plus 30%, right? Well, that's not real, because that unfunded liability, the amount we need to collect for the unfunded has nothing to do with those 3 new teachers. And so it's creating a human capital decision-making problem. And so by able to take that 27% and separate it out into a dollar amount and say, no, you're putting in $10 million for this, regardless how many people you hire, helps them to actually make a better decision from that perspective. So while it's really easy to collect the contribution rate, there can be some other, things going on that you wanna make sure is not happening. And this is one that kind of solves some of that.
Open up for discussion.
Questions or comments?
Well, we thank Mr. Hitchcock for the opportunity.
Yes, sir.
Thank you guys. It's been informative, and we
Thank you,
definitely
guys.
appreciate you coming.
Okay, thank you both for being with us. We've learned a lot from your presentation. Thank you.
Mr. Chairman, Mr. Chairman, I would ask for the opportunity for the commission to go into an executive session to just, I believe, under the provisions of our exception to one of the items that we can go into executive session for is to discuss potential investment impacts regarding the annual investment plan. And I would ask that we do that at this point, and that as part of that, we would leave in the CIO and the chief legal officer, if that's okay.
You say need or?
Yeah, leave,
Okay.
yeah, everybody else, I would ask that.
So I gather there's an urgent reason to do this, and
So moved.
Second.
is there a second? All in favor of moving into executive session, say aye.
Aye.
All opposed, say no. Okay, we move into executive session now.
We might get you.
I couldn't be there. We've suspended travel for the time being, so I apologize for canceling on you. But also, if you'd like, I'd love to come down there later when the dust clears. Help me understand. You've got about how much time do you want to take, and
Like 45 minutes.
you've got about an hour, I guess, or
that's fine.
45 minutes.
Yeah, that sounds good.
45.
Yes,
Yeah. Would you like, maybe the easiest thing is, in light of the back and forth, perhaps we should try to hold questions till toward the end, or do you prefer to have questions as you go?
We could do it either way. If you have a question, just ask.
Teach
It's
us
good.
Yeah, we'll see.
Yeah. So, okay, well, I'll get started. Okay, good, this is working. Well, first of all, as you said, there's a lot going on right now, obviously. In the near term, what happens with the virus is going to have a big impact on what happens with the economy and to some extent with the market. How that plays out over time will be impacted by the underlying conditions into which this situation arises. So mostly what I'm going to do is I'm going to focus on the underlying conditions, and then I've also got some material in here related to the virus, so we can talk a little bit about that. We're not experts on virus, but of course we do talk to experts on virus, so mostly I can share, what we hear, but obviously there's a lot of uncertainty. So let me start on this page 2, and these are sort of some of the summary points that I thought would be worth getting out there. So the first thing is that it's important to recognize that as we watch, as conditions unfold in the near term, those outcomes are being substantially impacted by longer-term secular debt deflationary forces. The way that the last expansion transpired, actually the financial crisis, starting from the financial crisis all the way through that 10-year expansion to the tightening of monetary policy, the effects of that, and then where we are now, those outcomes are all, while they're shorter-term cyclical outcomes, those cyclical outcomes are being impacted by longer-term secular forces. So it's important to recognize that, and I'll go into some of that. The second thing is that then, as we look at where we are now, I think we've transitioned from an extended but weak expansion to a new cycle that's not going to look like cycles of the past. One of the ways that I've described this is to say that, that we're not going to, that the boom bust cycle as we know it is probably ended. Meaning, if you go back over the last, 50 years or more, the boom bust cycle, the expansion and contraction of the economy has been driven largely by monetary policy. There's an easing of policy, you get an expansion that carries on for some period of time until you get excesses, you get inflation pressure, then you get a tightening. The tightening ultimately produces a downturn. The downturn produces an easing, and so on and so forth. And so the economy, inflation, interest rates, and monetary policy are up and down, and mostly driven and under control of the central bank. And as we go forward, that's not likely to be the case. Probably the 2018 tightening was the end of that kind of process, because the degree of the response that markets and then the economy had to what was really a very moderate movement, and also the lack of inflation going into that and the lack of inflation coming out, and uncertainties by the central banks about what's driving inflation, has really, that whole set of circumstances has changed the monetary policy response function. They're much more aware of the asymmetries. In other words, the unlimited ability to tighten and the heightened sensitivity of the economies to that tightening, and the limited ability to ease monetary policy, to reverse any sort of a downturn puts them in a box. And so they won't be really preemptively tightening again with respect to inflation. They'll be waiting for inflation to actually show itself and so forth. And given the secular forces, it's not likely to show itself. So we've entered a new period where central banks are likely to, the policy function is mostly, let's keep this thing going as long as we can. So the third point is that the monetary policy as a tool for stimulation has reached the end of its useful life. It's going to have to be teamed with fiscal stimulation, what we call MP3, monetary policy 3. Monetary policy 1 is interest rate driven monetary policy. Monetary policy 2 is QE driven policy. And MP3 is when interest rates hit 0 and QE is fully utilized, that stimulating the economy and bringing it out of a downturn requires a combination of fiscal stimulation accommodated by monetary accommodation. The next point being, by the way, you can see my little hand here, right, that I'm pointing to?
Yes. Mm-hmm.
Okay, good, that helps. So the next point is, so given the deflationary overhang, central banks are pushing on the accelerator. The clutch is engaging badly, but the lack of inflation is licensed to rev the engine. That's the way you can think about it. So they're pushing, they're not getting much of a response, but also the lack of the response is inhibiting inflation, and the lack of inflation means you can keep pushing. And so that's the cycle that we're in. Now, that is mostly a cycle, a set of conditions that is most descriptive of the developed economy reserve currency countries. In other words, the U.S., Japan, Europe, UK. But increasingly, we're in a different kind of world we refer to as a tripolar world, where you have three dominant monetary and credit systems which are driving those economic outcomes within those areas. You've got a dollar-related system, you've got a euro-related system, and now you have an RMB related system, i.e. China. And the three of them have a roughly equal impact on global outcomes, but of a different nature between them. The dollar is still the kind of the world's reserve currency. Dollars circulate globally. There's dollar borrowing around the world. The U.S. is a big economy. Europe is a big economic zone. Europe is the most capital outflow in the world. And China, while RMB doesn't circulate outside of China, China is really the driving engine of China is the driving engine of Asian growth. China monetary and currency policy is the driving force of that, and Asian growth is the dominant force on global growth. So the three of you have really a tripolar world, and as the description that I've given is primarily pertains to the U.S. and Europe, and also Japan, but not so much to the emerging world and not so much to China and the rest of Asia. Next point is that we're going to see divergences in secular growth rates that are going to have compounded effects over the next 10 years. The compounded economic effects and wealth effects will have impacts on conflicts and the perceptions of power and so forth. And so the trade conflicts that we've seen in the last year or so are just the beginning of the types of conflicts that we're likely to see over the next decade, which can be trade conflicts, trade wars, capital wars, technology wars, cyber wars, and even, military wars. And then the last point here is that as we're moving into this next decade, coming out of a certain environment, by and large, markets as a general rule discount existing conditions and react to change. And so largely what's discounted across markets is a continuation of the same, and whereas that's not likely to be the case. And so the manifestation of that across markets, of course, differs one by one, but as a general principle, that's how that would be your starting point. So before I'm going to go through and illustrate, basically just sort of elaborate on these points. But I guess before I do that, is there anything in particular that you'd like me to comment on? Any questions about that at this stage? We'll go into it more.
Nope.
Not really? Okay. Okay, so this is what we refer to as our template for understanding the world, or understanding how an economy works. It's a relatively simple template, but it's very helpful for processing what's going on. And essentially, the basic template is that there are three forces that really drive economic growth. There's productivity, there's a long-term debt cycle, there's a short-term debt cycle. The reason that it's these three things, before I get into it, the reason that there are these three things is because GDP is spending, and spending can be financed by either income or credit. And productivity is your primary source of income. People pay you for your value added, that's your income. And so productivity is a source of long-term growth trends. It doesn't really have much impact on short-term cycles. And so that's the driving force of income, particularly real incomes. And then credit is the biggest driver of the shorter-term moves in economies. And there are two elements to the to credit conditions that are most important. I'll start at the bottom. Of course, you've got the business cycle or the short-term debt cycle, which is the expansion and contraction in credit that happens over a kind of a few-year period, mostly driven by changes in interest rates. And then you've got a long-term debt cycle, which relates to the level of debt. And the long-term debt cycle and where you are in that long-term debt cycle will impact how that short-term debt cycle plays out. So let's say from 1950 to 2008, we were in a long-term debt cycle expansion period. There was a leveraging up, a gradual leveraging up in the economy. And when you're leveraging up, that means you're borrowing. And when you're borrowing, you're spending it on something. You're either going to spend it on goods, you're going to spend it on financial assets. And either way, it either supports growth or it supports asset prices. But you hit a limit where the level of debt inhibits the ability to borrow more. And when you hit that limit, the responsiveness of the economy vis-a-vis the short-term debt cycle, vis-a-vis in response to changes in interest rates, is then muted. And so the thing that we've been going through over the last 10 years is a muted response to a very aggressive monetary stimulation. And then what we experienced in 2018 was a heightened response to a relatively moderate tightening. And that's reflecting the fact that in 2008, we made a turn here. We turned from kind of an expansion phase of this long-term debt cycle to a deleveraging type of environment. That's the case in the U.S., Europe, Japan, UK largely, but it's not the case everywhere in the world, not the case in China. They would still be in an expansion phase. Other emerging economies could be in the expansion phase. And so going forward, you're going to have different parts of the world at different stages of that long-term debt cycle, which is going to have longer-term impacts on growth rates, but also shorter-term impacts on how they respond to different conditions at the time. So taking a look at that, developed economies are in the latter stages of the long-term debt cycle and the business cycle. This is what I was referring to. This is debt to GDP in the United States since the 50s, rose by a factor of 3 to this level. We had the peak right here in 2008. We had the deleveraging, and then at that point, Bernanke cut interest rates from 5% to 0 because of the deleveraging pressure that didn't stimulate a credit expansion, and so he started printing money, and ultimately was successful at halting the decline in debt to GDP. Without that, we probably would have had a deflationary depression, but as it is, we had an expansion. This is the cut of interest rates to 0 and held there. This is then the printing of money once that didn't work. And this is very like the 30s, where you had a cut of interest rates to zero when you had another deleveraging environment. Cut interest rates to zero, you don't get a response, and then you print money to get things going. Now, when you look back across countries, when debt to GDP is rising, you tend to have higher growth rates, higher inflation rates, and higher nominal growth rates, because debt to GDP rising means there's more borrowing and spending going on. When debt to GDP is not rising, either sideways or flat, sideways or down, growth rates are about a third lower, inflation rates and nominal growth rates are about a third lower. So it's not surprising then, and it's perfectly consistent with the mechanics that we see, that over the last 10 years, this expansion was the slowest expansion on record. This blue line is the cumulative growth in GDP from the bottom, slowest expansion on record. Also the longest expansion on record because, A, you started from a low level, but also you grew at a slow rate. And so you didn't really hit capacity limits until later in that period. Now, despite the fact that that was the slowest expansion on record, over the last 10 years has been the highest asset returns of any decade. These gray lines here are every 10-year period and what a global 60-40 portfolio returned. The blue is on average what it would have done over 10 years. Like I said, this is every single case. And the red is the one that we just experienced. So that was the best of any 10-year period since 1970 on any rolling 10-year basis. That was the best we've had. That was despite the fact that it was the slowest expansion on record. How did that happen? The way it happened is because we had a big decline in risk premiums and a big decline in real yields. So starting from here, risk premiums had a lot of room to fall. We got a lot of printing of liquidity by the central bank, and so the decline in risk premiums essentially raises the present value. Think about the sum of the risk premium plus the real yield as the discount rate on the cash flows. As the real yield falls and as the risk premium falls, the discount rate falls, and as the discount rate falls, the present value of future cash flows goes up. So even though the cash flows are not rising that fast, the present value of the cash flows is going up a lot. Now, as we now start from here going into the next decade, we start from a low level of risk premiums and we start from a low level of real yields. And so the ability to repeat that doesn't exist, obviously. And as you then look forward, it's something that implies that the expected returns of assets will probably be lower. Now, when you think about that template, remember you finance spending through either credit or income. The deleveraging pressure and the high level of debts here kind of preempted income growth, and we're still at a high level of credit growth, and we're still at a high level of credit. So and we're at zero interest rates, and so it's going to be difficult to stimulate credit growth. Looking back again, while you didn't get much credit growth, you got a lot of income growth. So that expansion, which was the slowest, was financed largely by income, not credit. And that income growth took the form of a decline in the unemployment rate. In other words, when you start with an unemployment rate of 10%, and now you decline that unemployment rate over time, over 10 years, you're putting more people to work. And as you put people to work, you have more income. And as you have more income, you have more spending. And as you have more spending, you put more people to work. And so it's a self-reinforcing type dynamic. So that the above trend growth that we did get over that decade was mostly coming from a decline in the unemployment rate, putting more people to work, and rising incomes. We see the same thing in Europe and Japan. And so as a result, the growth of employment here was faster than the growth of the workforce. That's the same thing as saying the unemployment rate came down. But that can only continue for so long because the unemployment rate is, it went from 10 to 3, but it's not going to go from 3 to -7, right? So at some point that unemployment rate starts to hit its lower limit, and then assuming unemployment would just go sideways, that means that employment growth starts to grow at the growth of the labor force, which is the red line here. So in time, what's going to happen is that the growth of income will start to be roughly equal to the growth in the labor force, which is relatively slow because of demographics. At the same time, that the growth in credit will also be limited because the level of debts is high, and the ability to cut interest rates to stimulate expansion is limited. And so what you're going to get is you're going to get a convergence of growth rates toward what we refer to as potential GDP, which is essentially the growth in productivity, the growth in the labor force plus the growth in their productivity. And you're going to get that across the reserve currency countries. And that'll be happening at a time that the level of yields and risk premiums is low. Now, so what kind of a potential growth rate are we graduating, converging towards? That'll be a function of productivity. And this chart right here is our 10-year growth estimates just based on productivity. In other words, we've got a study we can send along. You've probably seen it, but we've identified the main drivers of productivity over the next 10 years across countries. And it's things like investment rates and innovation and the rate of patents and culture and hard work and all these kind of things. And so if you look forward, you see the blue line here is the developed world, and it's kind of 0 to 1.5% productivity growth. And the emerging world, particularly Asia up here, kind of 4 to 6% productivity growth over the next decade. And so as we look back, and the growth of potential GDP in the developed world has slowed from kind of 3.5% back in the 70s to about 1.5% today, that will probably continue to slow because lower productivity and also demographics. And so as we go forward, we're going to be getting a cyclical convergence in growth toward long-term trend growth, and long-term trend growth will be at a relatively slow and slowing pace. So we're looking at kind of an environment of 1% growth is what we're headed toward. Did I hear a question there at that point? No, maybe not. Okay, so then what are the odds of a downturn, and what are the odds of what are going to be the near-term drivers of those outcomes? Well, the main driver of cycles is the production of liquidity in the form of money and credit. That's what gets spent on assets and the economy. And there are basically 3 stages of that liquidity pipeline. At the front end of the pipeline is the central bank, which generates liquidity through either the interest rate changes or money creation. And so here you can see this rise in interest rates in 2016, 17, 18. The rise in interest rates and the pulling back on the money creation was the tightening that produced the bad performance in markets in 2018 and the slowdown in 2019. That has been reversed. They've then cut the interest rates and they've started printing the money, so they've reversed course on that. So there's plenty of liquidity out there. The second stage of the pipeline is the financial system, the flow of credit. That was the deleveraging pressure. The bubble was too much credit. Then you had a bust. You had the boom. Then you had the bust. And now we've got kind of a gradual flow of credit. And the reason in 2019 that we didn't have a downturn in 2019, just a slowdown, is because the flow of credit was sustained, and therefore that put a floor under growth. Normally what happens when you get a tightening in monetary policy, you get a pullback in credit. That occurs at a time after you've had a big leveraging up, and then you get a pullback in credit, and that causes less spending, which causes less income, which causes less spending, and so forth, and you get kind of a chain reaction in that system. But if the flow of credit is sustained, it puts a floor under that. And that's the thing that prevented 2019 from being a downturn versus a slowdown. This is the key variable today as we look forward. Because as you have the virus is going to affect spending and it's going to affect income. But it doesn't have to have a self-reinforcing compounded effect on economic conditions. It may or it may not. It will if it starts to affect the flow of credit and you start to have a pulling back of credit and loan losses and credit losses, and you start to get second and third and fourth order effects through the system. If you just have a pullback of spending and income, you might have a really bad quarter of GDP growth. You might have a very bad quarter or two of earnings, but eventually, if it doesn't crack through the firewall of the credit system, you will bounce back. Now you're going to bounce back. You would bounce back to a slow level of growth that I described earlier, but that's what would happen. On the other hand, if you start to see credit problems and a squeeze, that is when you have a self-reinforcing contraction, which is a very dangerous situation because the central banks lack the ability to pull us out of it. They've already pushed interest rates almost to zero, and they also lack the QE. They can print all they want, but they've already driven the asset prices up, and so there's not a whole lot of room for QE to have an effect. And so at that point, what you would need is fiscal stimulation. And fiscal stimulation means you need the government to take effective action, which means you need cooperation in the government, such as we had in the virus plan. But you sort of need a difficult set of circumstances first in order to pull everybody together. So this flow of credit is a very important thing. That's the second stage of the pipeline. The third stage of the pipeline is money moving from cash to assets or assets to cash. If money's moving from cash to assets, then it's moving from cash to spending. And debt is a short cash position, meaning borrowing money is the same to spend is the same thing as moving money out of the bank and spending it. And so one of the best measures we have of whether the direction that money's moving is the all-weather return that we have, because that all-weather portfolio is neutralized to growth and inflation. It's really just isolating changes in risk premiums. And so what we have is in 2018, we had the tightening. Money was moving from assets back to cash. That was reflected in that all-weather portfolio having a return lower than normal, a little bit of a loss. And since then, since the central bank started to print liquidity and push the interest rates down, we have the money moving the other direction, going from cash back into assets. And so, all weather's up, whatever, 13 or something over the last 12 months. So that's a good for now. In fact, even this year, with all this stuff going on, I think all weather's up 2.5% or something like that. So we're not getting a tightening of risk premiums. We're not yet getting a tightening of liquidity. We're not getting a downturn in credit. We're getting an expansion of central bank liquidity. So if you looked at it right now, you'd say we're getting more central bank liquidity, we're getting a flow of credit, and money is still moving from cash into assets, and risk premiums have actually come down a little bit. And so you would say that liquidity pipeline is a supportive influence on the economy right now, at the same time as the virus and pulling back is a negative influence. And so that would make you positive on conditions kind of after the pothole. You'd be looking at it as a pothole, not as a serious ditch. So that's where we are. Now, when we look at the conditions of the financial system and their ability to sustain credit, they're in very good shape. Two very important things that drive that. Number one is, I think the most important thing is actually liquidity and the funding liquidity of the banking system. When you look at past downturns, downturns occur when the banks are funding in the wholesale markets out there, issuing commercial paper and large CDs and overnight repo and so forth. The banks are funding the wholesale markets, and that's passing through into an economy, like we had where people are borrowing against their houses to buy cars and that kind of stuff. And then you get a pullback in the financial system, and then that affects the funding of the banks, which affects the lending to the banks, which affects the spending in the economy. Those all pull back. Today, the banks are not funding in the wholesale markets at all. They're funding all their operations with core deposits from retail. The second thing is capital ratios, and capital ratios are very strong. They're way up from where they were. So there's plenty of capital, plenty of liquidity. And then as a result, when you see bank credit standards, every downturn that we've had since they started doing the surveys has been preceded by a tightening of credit standards. You don't see a tightening of credit standards right now, because that's a result of that. So that underlying flow of liquidity is a positive against the downward force of the virus. But at the same time, you're going to have a gradual secular decline in growth toward those slower growth rates. Now, in the meantime, it's been 20 years since we had inflation above 2%. We're sitting here still always waiting for inflation. And, this is the United States. There's 2% right there. And, it's been 20 years since we've had anything more than 2% inflation. And the markets are pricing it's going to be 2% inflation for another 10 years. And the same thing in Europe, same thing in Japan. 80% of the economies in the world have an inflation rate between 1% and 3%. And the ones that have an inflation above 3%, it's headed down. This means that the central banks have the leeway to maintain that liquidity, which they have now decided that they will do. They have decided that they're not going to preemptively worry about inflation. They're going to wait till they actually see it before they take that tightening action again. And of course, they're going to be very reticent to do that, recognizing that if they tighten and cause a downturn, that they don't have much ability to reverse it. So that's the last thing they'd want to do. This just reflects what we refer to as fuel in the tank, which is how much latent stimulation is available to central banks. Not much. I think it's obvious. And so we're transitioning to a new monetary policy regime. Developed economies are in the latter stages of the long-term debt cycles and business cycles, looking at slow growth, low inflation, near zero interest rates, and plenty of liquidity. Monetary policy is now a weak lever, which increases the dependence on fiscal policy, coordinated with accommodated monetary policy, what we call MP3. There's policy asymmetry, meaning you can tighten but can't ease. There's no preemptive tightening with respect to inflation. And the goal is, let's just keep the expansion going as long as we can. This is a little bit of a description of MP1, MP2, MP3 and how they work. I can come back to that if you're interested, but in the sake of time, I'm moving here quickly. As you look across the world, and you sort of have the scoreboard, MP1, MP2, MP3, Europe is done. MP3 is their only lever. Japan is done. Switzerland done. US close to done on both. UK close to done. China has all three available to it still. Then there's also the currency lever. You can devalue the currency to stimulate your economy. When everybody tries to do that at the same time, what happens is you have a decline in the value of fiat money in relation to gold. And so this is the price of gold in each one of these currencies in 1929 when you had the printing, 2008 when you had the printing. And so, that's a typical reaction function there. And also that opens up an interesting thing that you all might think about at some point, which is denominating some of your assets in gold. And I'm not saying sell assets and buy gold. I'm saying think of gold as a currency or as actually a contra currency to the fiat money, and take some of your equities or your bonds or whatever and denominate a portion of that in gold as a currency. That can be a hedge to inflation. and it can also be a hedge to crisis periods along the lines of what we've seen this year. Now, this environment is just going to increase populism and political conflict inside of economies. These are some metrics, the share of congressional votes cast along party lines here is 95%. It's the highest since 1900, highest ever, basically. Our populism indexes, it's the population all around the world, like in the 30s. The environment is most like the 30s. Now, back to the tripolar world, it's not the same everywhere. If you take our template, these three forces, the policy levers available, and then the incentives to move money, being in the yield curve and what I call the risk curve, which is the yield on equities relative to bonds, the U.S. and Europe are in a down wave, weaker growth, low productivity. MP3 is the next lever. Plenty of fiscal room. In Europe's case, they don't have a central government, though, to take that action. Yield curves are flat, not much, moving out the curve. Risk curves are relatively good. In other words, equity yields relative to bond yields. Whereas if you look at the third pole out here, the renminbi, you're in a very, very different set of circumstances. Upwave, moderate growth, high productivity, all three levers available, fiscal policy available, normal yield curves, and a relatively high risk premium in the assets relative to bonds. And so as you then look at Asia, I think it's a very important thing to start thinking about Asia, not just China, obviously China, but not just China, Asia. We think in terms of this Asia bloc, which is an emerging Asia bloc, which is China plus 7, 8 countries. I listed them down here: Hong Kong, Korea, Malaysia, Singapore, and so forth. Countries that are now operating almost like a single economy because production is moved from one place to another in a very fluid way with very low costs of transportation between them because it's mostly vis-a-vis waterways. And so this economic zone is emerged as through the efforts of private businesses, but now policymakers are encouraging it, and now as a matter of self-defense, it's expanding. And so this economic zone is developing. There's more trade among those countries than there is among the countries in the Eurozone. So there's a lot of activity going on between them. It's also big. When you look at the output of that Asia bloc here, the red line, it's almost equal in size to the combination of the U.S. plus Europe in terms of the level of output. And if you look at the output, the contribution to global growth in the last 3 years, it's been 2.5 times the contribution of the U.S. plus Europe. I'm not saying U.S. average of U.S. and Europe. I'm saying U.S. plus Europe. And so that's a driving influence on global growth right now. When you look at the nature of that economic zone, it used to be that it was a manufacturing center and export to the West. That has changed, and now it's much more of an independent, inwardly focused economic zone, trade among one another. And you can see that in how nominal GDP of China and the other countries beyond China has accelerated while the exports have stabilized. And so it's increasingly trade within the zone, which makes it more independent. It used to be that it was like a high beta version of global growth, and so you got no diversification advantage from investing there. You now get a very good and increasing diversification advantage from Asia, emerging Asia, because of the independence of the monetary and credit system that's developing and the increasingly inwardly focused nature of that economy. So that's something I'd be thinking a lot about. When you contrast the picture that you get from the East and the West, the red line is the growth rates in the Asia bloc versus U.S. and Europe. These are the projected productivity over the next 10 years. This is the level of interest rates. This is not quite updated. It changes every day. It's the level of interest rates. Interest rates are higher, more room to ease. And when you look at the earnings yields are higher. So higher interest rates, higher earnings yields, higher productivity growth, and higher concurrent growth right now. Now, that you're going to get an increasing conflict, though, between the West and the East, and particularly between the U.S. and China. That conflict is not just a trade war; it's a conflict between U.S. and China, which is an ideological conflict of comparable powers in a small world. They have two different systems, bottom up versus top down. And Graham Allison wrote a book called Destined for War that he describes a phenomenon called Thucydides' trap, which is the conditions under which the incumbent power is challenged by the upstart. And throughout history, 12 of the last 16 times that's happened, you've had war. The good news is that everybody's aware of it now, and so hopefully that can be avoided. Nonetheless, you're still going to have conflicts of various sorts. You're going to have, trade wars, maybe capital wars, maybe cyber, maybe technology. So there's a lot of that that's going to be going on in the next 10 years, and particularly if Asia continues to outpace the West, that just increases the conflict and, probably to some extent blaming and that sort of thing. And if you have a win-lose situation, picking the winner is not really obvious. And so we're much more inclined toward geographic diversification than we've been in many years. And when I say geographic diversification, keep in mind that when you look at trailing correlations of markets, those correlations reflected conditions at the time. You didn't have three monetary systems, and you didn't have that kind of balance in the global economy going backwards. Going forwards, you're going to have different set of conditions, and so you have to think about the fundamental drivers and diversify by monetary system, stage of the long-term debt cycle, stage of the business cycle, and so forth, as listed here. And then the last point is really diversify, but also stress test. One of the things that we've built out is that we've built out a good stress testing tools that you can use. We stress test like crazy for ourselves, but we've built out tools that allow you to stress test your portfolio and your strategies through all kinds of circumstances through time. And in our strategic report this year, we had a whole section on that, which you could refer to. But for example, here, what if you have inflation with a pro-labor movement and policies like UK in the 70s? Okay, if you have a certain kind of portfolio, it does this. Another kind of portfolio, it does that. And different kinds of environments, all kinds of environments over the last 100 years. So that's available to you, so that you can you don't have to use your imagination to come up with scenarios. You can just take your portfolio and just run it through all those different scenarios and see how it looks. So that's what I've got. That's the underlying what's going on. And then, of course, we can talk about viruses and everything else. So go ahead.
Bob, this is Jeff. We tend to be global in our focus, but as you certainly know, non-U.S. in equities and frankly in rates has been a bit of a challenge. I'm curious how are you guys thinking about that question? You showed us 60-40. I assume that was U.S. only. How would a 60-40 global portfolio map over the last 50 years?
I thought that was global, maybe not.
Was it? It may have been. Okay. Oh, yeah, it is global.
Yeah, that's global.
Okay.
And the U.S. would be even better. I mean, and so one of the best decades ever for the United States. I mean, I think the answer is, as you go from decade to decade, we might have this in the compendium. Jen, Bill, if you're on, let's see. I sent a compendium of our research across. And Bill, could you take a look and see if that's in there of the kind of the decade by decade? We probably should have put the geographic diversification one in there. I forgot that. But anyway, as you go from decade to decade, you see every decade there's somebody's at the top, some countries at the top, somebody's at the bottom, and there's no prediction, and there's no the best predictive ability is whoever was at the top is probably closer to the bottom in the next decade and vice versa. And that's because what happens is that when you go through a good period, that good period basically gets priced in and it's subject to disappointment. And likewise, when you go through a weaker period, that gets priced in and you're more susceptible to an upside surprise. When we look at, and we could go through the different valuations with you, but let's say if I go back over the last 10 years and I just compare U.S. to China, for example, the U.S. has way outperformed China over the last 10 years. But there are reasons for that. And the reasons for it are things like you had expanding profit margins in the United States, to some extent because of the opening up of China and the use of the labor force there, which allowed higher profit margins for U.S. companies. The same dynamic hurt Chinese companies because as wage rates then rose in China, that hurt. The wage rates go up faster than the productivity within China, and their profit margins come down. You've also had a tightening of credit conditions in China and a rise in risk premiums as they were trying to preempt the over-leveraging of the economy, and that pushed risk premiums up and interest rates up. At the same time as in the United States, you had the easing in the production of liquidity that pushed the risk premiums down. So we could go through a bunch of those drivers. One of the things I do have back here in the back is a interesting comparison of how. Hold on just a second. If I take this is U.S. equity prices indexed to 1999, and the blue line is the U.S. equity price, and if you take away some of the non-recurring things, you can recalculate what the return of U.S. equities would have been. So if I start here, and if I just take away the effect of falling interest rates, basically a lower discount rate on the same cash flows, you'd have this red line. If you take away margins rising, you have the orange line, in which margins can't keep rising forever. So if you take that away, you've got the orange line. If you take away the corporate tax cuts, you have the gray line. And then if you take away the high level of buybacks and M&A, you have the green line. And so you go from, stock prices going from 100 to 250 since 2000 to them going from 100 down to 75. So there's a big support to the U.S. equity market that came from those forces that were not necessarily the case in foreign economies. And so maybe it would be helpful, like you said, if you've been hurt by having a global exposure, maybe it would be helpful to sort of view how these various forces impacted that looking backward return, and then take an assessment of those things on a looking forward basis.
Thank you.
Here's another one here. Like this is, we've been in a 40-year period of pro-business environment. You go back to Reagan and Volcker. If you think about, who is favored by culture and policy, and I think there are three big constituents. There's business, there's labor, and there's the consumer. And since 1980, culture and policy has favored business and the consumer. Bring inflation down, support business, globalization, M&A activity, and so forth. And so, and at the cost of labor, particularly American labor. So these are some statistics that show that. This is the amount of regulatory scrutiny that's been going on over time. That's, less and less stringent M&A restrictions, the corporate tax rate coming down this way, the degree of globalization, cross-border capital stock going that way, union membership coming down, collective bargaining taken, the power of collective bargaining taken away. So you basically shifted power from labor to business, and central banks had tight money, which brought inflation down, and globalization also contributed to lower inflation. That pendulum is swinging the other way. It's swinging toward labor from business. And I think even the election of Trump was a reflection of that. But his strategy, his way of supporting labor was to support business. But that's not, that may or may not be the tactic, but one way or another, you're getting a pendulum swinging that other way. Whereas on a trailing basis, people are largely extrapolating the past into the future. This is the extrapolation. This is really what's priced into different markets. And so in the United States, where the market's discounting this kind of earnings growth over time, which is largely an extrapolation. In other developed economies, this is kind of sideways earnings growth. And then very interesting in emerging economies, particularly if you look at it on an unhedged basis, where their real interest rates are higher and their currencies are down. And so therefore their currencies are discounting a big decline in real exchange rates at the same time as they're discounting weak earnings. That combination means that the discounted future earnings in emerging economies relative to the United States, looks like this. So the world, and now that's what we've had, right? Since 2010, we've had earnings in emerging economies way underperforming the U.S., and that's largely being extrapolated to continue into the future. As you look back, this condition right here was a drag on your global portfolio as the actual earnings underperformed, and actually, if you go back to this point, it would have been discounting that they're outperforming. So they were discounting that they'd outperform, extrapolating that move. They got surprised on the downside. Now they're extrapolating that that's going to continue.
Hey, Bob.
So that's a big driver looking back, and it'll, I think that won't necessarily be the scenario looking forward.
Bob, can you give us a sense of if those trends, the U.S. and EM trends, don't extrapolate, but just flatten out at the existing levels? What are the implications for equities in those markets?
Well, markets, the returns of markets is always driven by how things transpire in relation to what's discounted. So that's why when you look back, one of the reasons that when you look back and you see that there's no correlation between high growth and low growth and equity returns across countries, because high growth can be over discounted and low growth can be under discounted. So it's all relative to what's discounted, and there's sort of a 50-50 probability of being on either side of that. So if you take that principle, if for example all of these just went sideways, what you would see here is that U.S. earnings would then be underperforming what's discounted, and you'd have weak returns. In Europe, you would have something probably just kind of earn the yield carry against bonds, or the normal risk premium against bonds. And in emerging economies, if you went sideways, that would actually be a big positive surprise relative to what's discounted, so that would mean good returns.
Bob, this is Ron Wilder. Would you just share a little bit of what you're hearing about the coronavirus?
Yes, sir. The nature of first of all, hardly any testing has been done in the United States to this point. So any reported cases are not indicative of the status. That's the first thing to recognize. Literally, I talked to my doctor yesterday. I said, hey, can I get a testing kit? And he goes, well, no, actually, and I don't have one. If I wanted it, I'd have to call the CDC. And actually, Norwalk Hospital doesn't have any either. So we don't know what the situation is. The thing that we do know is that the virus is highly contagious. It's got a kind of 2 to 14 day gestation period before you have any symptoms. And during that period that you don't have symptoms, you are contagious. And that's that means that the virus is being transmitted by people who don't even know that they have it. It's transmitted in two primary ways. One is by coughing or sneezing, but you have to be in close proximity to that person, 3 to 6 feet, but also by hands as you, doorknobs and that sort of stuff, and then you touch your face, and then, then you have it. The virus itself is a pulmonary virus. It goes to the lungs, which is why it produces the pneumonia. But the contagious nature of it is such that it's highly contagious because you don't know if you have it. And the people we talk to equate it to the H1N1 virus, the swine flu in 2009. Eventually, the swine flu infected 59 million Americans and 10 to 20% of the world's population because of the same reasons. The swine flu had a low fatality rate. This one seems to have a higher fatality rate. We estimate basically a 0.5 to 1% fatality rate. And so, if you had, let's call it 10% of the United States gets it, that's 700 million people, times 1% is, 0.5 to 1% is a lot of deaths. So it's very dangerous. Yesterday we had an all-company call. Our guy, Richard Falkenrath, who worked for the White House during some of these past epidemics, who worked for the state of New York, or city of New York after 9/11, Homeland Security. His contacts said 30 to 40% of the people could get it. So this is something to be careful about. Now, in terms of the patterns here, I had a chart in here that's useful. Going back and looking at the swine flu as an analog, Wikipedia's handy. I pulled this out of Wikipedia, but it's a nice image of how this thing works. This is a period in 2009 between April and June, so it's a 3-month period. And each one of these lines is a number of cases in each one of these countries, kind of starting from 0. So from the time it enters the country, what's the rate of expansion? And it's on a log scale over here, so it's really kind of represented in percent acceleration terms. But what you see here is that there's a pattern of about a 3-week period of acceleration, and then kind of a leveling off of the rate of growth, though still an expansion after that. The swine flu lasted from around April of 2009 to toward the end of 2010 in total. So I think that if you were looking at our situation today, we don't know hardly anything because we don't have any testing. We will have testing in about a week or so. You're probably going to, at that point, discover there are a lot of cases. My base case is there's at least 1,000 in New York and whatever. But anyway, you're going to find all of a sudden there's a lot of cases out there. And probably we are in this acceleration phase that we're some early in this acceleration phase, which would give you sort of a 3-week to 4-week ramping up if this sort of pattern was representative. So, we think it's a serious thing, could be a once in 100-year type of thing, and, be careful. Otherwise, in terms of the economic effects of this, you could have a lot of people die and it doesn't actually affect the economy. What affects the economy is spending, and so it's a terrible, tragic social outcome. But if you're then trying to translate that into the economy and the markets, it's as I described, which is that GDP is spending, and spending is financed by income and credit. And so the economic and market effects of this are because people are staying home, they're not spending, or they're not working. and income and spending take a drop. You take China as an example. It's a perfect example. They all stayed home. There's probably zero GDP in the first quarter, zero GDP growth in the first quarter, and then there'll be a gradual recovery of that. So, and then whether there's a more permanent effect will depend on how it passes through the credit system in the way that I described. But that's what we're looking at ahead of us. And then in terms of the markets, a stock price should be the present value of 20 years of cash flows or something like that. And so one bad quarter, one bad year of cash flows should not be the be all end all of stock prices. We've done a calculation in here that we estimate, I don't know if I got it in here. Here we go. That the price decline to date, it probably equates to about a 50% decline in earnings this year. In other words, that's probably what's priced in, because you have to look at how much the stock price fell versus the countervailing effect of the interest rate falling. And so it would have fallen a lot more if the stock price hadn't fallen, if the interest rate hadn't fallen. So you back all that out. It's very, very, very rough, but maybe a 40% decline in earnings this year is what's priced in.
Thank you for that.
And then recovering after that back up to trend. And so you'd have 1 year out of 20 essentially at half, and then that's the present value effect on the price.
I think we're just about out of time. Are there other questions?
Yeah, I have one, Bob. Obviously, y'all trade gold, but also a lot of bonds. If U.S. rates flatten out, that's a large part of the market segment. How's that change implementations?
Great question. I'm probably going to write a report on that one. The role of bonds in this world. A couple of things to register. Number one is that there's no zero floor on real yields. So if you think inflation index bonds, the real yield can go very negative and is already negative in many countries, much more than the nominal yield. And so the potential for price appreciation from declining real yields continues, even when the nominal yield doesn't. And so that's understanding that would be a topic I would put on the list. A second thing is that with bonds, there are two important types of return in bonds. There's the total return of holding a bond, which is basically going to be the bond yield. And so you look at the yield, you know pretty much what you're going to get. But of equal importance is the excess return relative to cash. And that's a function of the slope of the yield curve. So if I had a 1% bond yield and a zero yield on cash, I could still have a 1% risk premium on bonds, which is the same risk premium as if I have a 14% bond yield with a 13% cash. So the excess return of bonds is actually independent of the level of interest rates. And one of the ways that we use bonds is that we always hold bond futures, because bond futures is just giving you the excess return of bonds relative to cash. And so one of the ways you might be thinking about your portfolio is that instead of holding bonds, you could actually have a portfolio that holds everything but bonds, but you could overlay bond futures or swaps onto that portfolio, and you would get the price volatility effects and the risk premium of bonds as an additive impact on the portfolio, instead of holding bonds and having that being a drag on the portfolio return. That's the second thing. The third thing is that basically what central banks are doing is that they're pushing the interest rate, the bond yield, and the short rate down to the point that bonds are essentially not an investment vehicle, it's a funding vehicle. They're trying to make bonds a funding vehicle and get people to fund at the bond yield of zero and buy something else with that money. And so that becomes something that's a potential for creativity in portfolio structuring. But I think that is a topic to dive into.
And if I could ask one other follow-up, just because I was looking through the other day, like Chinese sovereign curve, at least when I pulled up, looks pretty normally sloped where, US curve still, even with the cuts the other day, still looks pretty inverted. Is that a true curve?
Yeah, for sure. Well, it's a real bond market. I mean, back on this page here, I said the same thing. The yield curve there is normal and the risk curve is high. The equity yield versus the bond yield is a high spread. When we built an all-weather portfolio of Chinese assets, it behaves just like the U.S. or the global portfolio because, those interest rates and earnings and everything, they comply with all the normal cause-effect linkages, and it's a huge bond market. So, that's for real there.
Well, Bob, thank you very much on behalf of the commission, and we look forward to another time when we can see you in person down here.
Yeah, likewise. I look forward to that as well.
All right.
Thank you for including me, and thank you for your accommodation.
Thank you very much.
Thank you.
Thank you, Bob. All right.
So now it's back into executive. Yep. So this is the end of that open session. May I have a motion to resume executive session?
So moved.
Second.
All in favor of resuming executive session, say aye.
Aye.
Opposed, say no. So, open is over, and, will you, take us back on the, agenda?
Happily. So as you can see, well, one-year return, this is as of 12/31. The one-year return was absolutely phenomenal, 16.8%. 24 basis points shy of our benchmark. And I'm gonna try to move as swiftly as I can. We do like to look at the cash flow, requisitions, deposits. So we are seeing the benefit very much of the additional funding. And here we have the asset class by asset class returns. And I am going to, in the interest of time, we are compliant. In the interest of time, I'm going to jump forward to the performance analysis. So I'm going to do this as efficiently as I can. Here we see what I hope are becoming familiar boxes. What are they telling us? They're telling us, A, 2019, phenomenal year, but as good as a year as it was for us, it was even better for a simple stock bond portfolio, which you can see up here as 21% was a 70-30 global equity and US bond portfolio. Second thing it tells you is we did well with our top-down portfolio structure decisions in 2019, but that benefit was largely in the first half when we had a large overweight to equities. And then the third thing that should be abundantly clear is here, manager selection. Our managers have been very much struggling on the whole to add value. Here you can see, sorry, I'm gonna skip that. Here you can see impact of portfolio structure decisions. So the decision to look different than the benchmark during the quarter. Scaled on the left, the first numerical column is the impact at the asset class level. And then on the right is the impact to the plan. And what you can see here is we had, I have highlighted four things. The equity overweight and underweight to equity options both helped. Our underweight to core fixed income helped. This is very much not the case for the rest of the year. Unfortunately, we've had continued drag from our master limited partnership exposure and the overweight position to cash that we have hurt during what was a strong quarter for risky assets. Here, we're moving into the manager selection. Top four impacts are GTAA had a very good year, continued to reverse what was a broader or a longer term, more troubling trend. The consistent performance from Portable Alpha is a positive. The alpha challenges in our public equity portfolio, you can see at the bottom, created an unfortunate story at the total plan. And our private equity performance was adversely impacted, it's not unexpected, by the fact that we did conduct a secondary sale during the quarter. Whereas the total impact from portfolio structure was positive, it was unfortunately more negative from manager selection, meaning we underperformed in the quarter. This is I want you to notice here, we have a block. Right now, we are able to take this back 4 quarters with a level of accuracy that we are comfortable sharing. We break this down into 2 clusters, fiscal year to date and the last 12 months. And what you can see here is public equity has contributed beneficially to us by being overweight during the first quarter, second quarter, and fourth quarter. Our private equity, the value here is a bit confusing. This is the difference between, in the policy, we use public plus a spread, and in the implementation benchmark, we use the universe benchmark. So this is not really something that I want to spend a whole lot of time on, but I want to make sure I explained. Portable Alpha as a structure was beneficial. During the year, the underweight to core bonds has hurt, most notably bonds in the second and third quarters. Then we move down into so this is portfolio structure up here. This is manager selection in the second box. Poor active returns in public equity and credit in 2019 hurt us materially. The hedge funds added value, but did not add the value that clears our estimate or our target for value. So it appears as though they are underperforming, but they did add value versus not having them. And GTAA had a very strong year. On a 3-year basis, 1/3 of our portfolio at current weight has outperformed benchmarks. Unfortunately, 2/3 of the portfolio by weight has underperformed. And you can see the dividing line here is the cash. So we've struggled in both equity portfolios. And over longer term, I mentioned GTAA has had struggles. Plan exposures, this is where I want to make sure I'm highlighting where we are overweight and underweight and how the portfolio is allocated. Bonds, we are underweight. We have fallen underweight Portable Alpha, but that is largely an impact of 2 things. It's not a lack of confidence in Portable Alpha. One, we have a portfolio that we are reallocating, so that unfortunately shows as a little bit of an underweight, but also the plan value has grown so much that our hedge funds that are not giving us those same exposures have not kept pace because that's not what they're trying to do. So we do remain underweight core bonds and I'm going to dive into the equity portfolio in just a moment. Within bonds, how are we allocated versus our targets? You can see that we're largely in line except for being underweight core fixed income due to the dismal prospective yield. And we are overweight cash, but underweight bonds in aggregate. So we are very liquid. We have a lot of flexibility, but this is where it comes from. Within the equity portfolio, we are slightly overweight U.S. We are overweight developed, non-US, and emerging market. We are underweight equity options at 12/31. And I've alluded to, more recently, we have taken some action in the portfolio to reduce the equity options underweight. In this portfolio, something that doesn't show up here is we do have a value bias both in the US and in emerging markets. And that is something that is not helped return. Value continues to lag growth. Here are the risk estimates. And you can see here our portfolio is slightly greater risk than the implementation portfolio. The implementation portfolio is slightly higher in risk versus the policy simply because we don't have the core bond exposure. Tracking error, just to get a sense, the biggest unit of tracking error is between a naive portfolio and the policy benchmark. I wanted to close on a high note, and I am not one who derives a lot of value from looking at how other plans are investing because I don't know their circumstances. But I think this is a little entertaining. Back fiscal year ending 2014 versus calendar year 2019, oddly, the median public pension fund greater than $5 billion generated almost exactly the same return. And I just, Mike and I were kind of surprised, a little bit surprised by this, but the parity there. But back in 2014, given the way we were allocated, we were not availing ourselves of those beneficial forces to the extent that we are now. So much so the policy benchmark had lagged back then by 2.4%, and I actually take it as a point of pride that we've made that a higher hurdle. But we have added risk in the plan in some, what I would argue, some thoughtful ways. And lo and behold, 2019, while our cohort was earning roughly the same as they earned in 2014, we were very much making better use of these opportunities. So not by any stretch, I do not believe that our work is done, far from it. But I am optimistic because these results for calendar year 2019 do not really yet reflect a lot of the beneficial things that you all have agreed to do in the portfolio. Co-investment is early. The changes we've made to the way that we prosecute private markets investments, we're only 2 years into that, and the results are favorable so far, but there's a lot more of that we expect to positively impact these returns going forward. But I just thought it was worthwhile to end this discussion, since we are at the end of the calendar year, that I would argue we are doing a lot better, and I'm appreciative for the actions that you all have allowed us to take and have encouraged us to take.
Jeff, a question. When you talk about the benchmarks and then you talk about the policy benchmarks, are these interchangeable or they're different, aren't they?
So that they have changed by weight largely. So we have more equity in the portfolio, so that changes the policy benchmark.
But the policy benchmark is set by us.
Yes. Correct. Yes.
As opposed to the benchmarks that you use to compare our performance.
So
I'm a little confused on that.
Well, we control our policy benchmark, and what I'm showing you is the policy benchmark from last calendar year versus the policy benchmark as it was when we had a lot less equity, a lot more credit, things like that. So it's the way we've changed our asset allocation has been productive relative to what it was 5.5 years ago, if that makes sense. So,
But when you talk about the benchmarks, measuring our performance against benchmarks, are you referring to this policy, or is it the S&P 500, a mixture of things that you put in?
It's policy.
That you've selected it? Oh, it is a policy, okay.
It's policy, yeah. So, but we've adopted the framework that uses policy benchmark, but it also has this implementation benchmark. I didn't know if that was what you were referring to, but that's just a mechanism for us to look at, okay, the commission adopts this policy portfolio. Our actual portfolio looks different, is designed a little bit differently. So we compare those, but I didn't know if that was what you're referring to. But in this sense, the policy is, the weight of the asset class times the benchmark for that asset class rolled up. That's the policy benchmark in this sense. So, I'm gonna stay out of the appendix. We have Makita's. Okay. Mr. Chairman, is this the final, agenda item, I believe?
Well, yeah, we're in, we're in reports, but yes, it's fine, yeah.
So, well, this is, okay, I'm sorry, I didn't mean to jump ahead.
That's all right.
So,
I don't think that's,
okay, I'll do this very quickly. Since we held over the AIP, at the last meeting, I highlighted new initiatives, I just wanted to share with you. The new initiatives that aren't in the held over AIP that we adopted, in the spirit of what the AIP seeks to have us do. We are making progress. We have completed the launch of the co-investment platform. We are in the midst of developing a plan for how we're going to integrate the use of secondaries into our private markets portfolios. And the others, I'm gonna say, we're still making progress on, but wanted to make sure I touched on that. So.
all right.
I'm not going to have CIO remarks, so.
Okay,
that's
very good.
beyond that, but I'm happy to answer any questions.
Okay, moving to other reports. The only thing in my report is just a reminder to be sure to file your ethics statements before the end of March. I had saved mine but not filed it, but I got an email reminding me I'd done it that way. And then the reports of the committee chairs. Bill Hancock has published his report. Any further comments today, Bill?
No, Mr. Chair, we got a lot going on, a lot of balls in the air, and things are moving very rapidly. You can read about it.
Thank you. Rebecca, report of the Human Resources Compensation.
Yes, the HRC committee met last week on the 26th. Mike provided staff updates on newcomers, and then the committee actually reviewed the charter to make sure we were in compliance, and we are. Good news. And then finally, Brittany provided a lot of information on the CEM benchmarking report of FTEs across other plans and how it compares to ours.
Any questions on that report? Okay, thank you. Report of the CEO.
I think I have a report, Mr. Chairman.
I've got a question, though.
Okay.
I can't let you go without a question. What are we doing with coronavirus? And I assume we've got a BCP plan, and we're gonna be able to
Yeah, we have business.
fund capital calls, or you know?
We actually, what was it? We have a cyber interruption plan, a business interruption plan, and about 3 months ago, we did tabletop exercises it was a hurricane, what was our tabletop exercise, but, so, yeah. And interesting, but we had an outside consultant come in and actually do the tabletop exercises for us, so this was not us, this was somebody else who came in and did it for us, so. But yes, we have those plans in place. And we can, if we have to, I mean, we're, you know, and I think the executive team will probably have a discussion about whether or not we needed to limit travel.
Mike, is there a state plan across the street that encompasses all the state agencies that we have to comply with, or Is that,
Um,
everybody doing their own thing?
Well, I think each agency has its own plan, but then our cyber is linked to, like, all of our IT is linked with PIVA. So we coordinate with them, for instance, on that portion of the business interruption plan. Brittany, our human resources director, has been getting continual information from, OSHA, CDC, SHRM, which is the Human Resources Masters thing that she's, designation that she has, their organization, keeping us up to date on what we should do. And we have hand washing signs in the bathroom, and the stuff like the, antibacterial stuff everywhere. But I think we're probably getting close to the point where we're just gonna.
And if we talk to all our managers, or, I mean, because what if they're down?
Yeah.
I mean, that's what we did. The reason I'm thinking about it is we had a meeting with one of our several of our investment advisors yesterday and over at SDO about it.
Yeah.
About communicating with them.
Right. We're in pretty much constant contact with our managers and but like, for instance, we're, and several of them, like, Bridgewater has a travel ban, Cape Cod does, some other firms do. So that's why I think we're thinking of, that's something that we need to do. But I think we feel we're we have all these plans in place as well, and I think we're in a good position to be able to weather. I mean, who knows? I think the problem is there's a lot of unknown at this point, but I mean, everybody has the ability to, everybody has a phone with a hotspot, everybody has a portable computer. We can, if we had to, we can work, like, if there's some type of, you can't come to the office, we can work remotely. All of our IT infrastructure is accessible remotely. So we feel like we're pretty good. I mean, we have both cyber and business interruption plans.
Right.
I think it's cyber incident plan and business interruption plan.
Anything further before we move to adjourn? May I have a motion?
So moved.
I'll move.
Okay. Thank you very much.